Okay, friends, hearty welcome to all of you for this program on a Friday. I know for some of you it is good evening, for some of you it is good afternoon, and even for people from US and Canada it is even good morning. Hearty welcome to all of you. It is good evening, for some of you it is good afternoon, and even for people from US and Canada it is even good morning. Hearty welcome to all of you to join for this session. Can you hear me properly?
Yes, sir.
Okay. So the topic for the day is personal finance do's and don'ts. I'm sure you are all serious with your personal finance. That is why you are here in this session. The problem in our country, India, is that personal finance is a very neglected topic. If you study for any course, including an MBA finance, you'll be learning the other finances, but you will not be learning personal finance. And you are not going to learn also in any course in India in future also, because if everybody learned the personal finance and how to manage their money, so many institutions has to be closed. There will not be any takers for most of the insurance policies, and some of the wrong selling credit cards and personal loan and all those things will have a problem. So personal finance is not going to be taught in any universities, even in the near future. But it is very, very important for you as far as your personal life is concerned, because you start working at the age of 25. And if you don't manage your finances well, at the age of 55, I'm sure you'll be still thinking of working on part-time to take care of your financial goals. I can tell you an example of two persons, A and B, joining the same job after the same course and working in the same organization for the next 30 years and drawing the same salary and getting the same level of promotions, etc. Let us name the people A and B. If A manages the finance well, and if B is not managing it, he is simply investing as per the random suggestion given by the TV people, media, nearby uncle, auntie, and all, the net worth of A at the age of 55 will be minimum 3 times than that of B, who is ignoring his personal finance. Now you can imagine how important it is. And as far as NRIs are concerned, it is very, very important, because you are working in a different country. You are leaving your family here, and some of the cases you are taking the family, but either way, you are losing the warmth of your natural place, India. Sorry. And after working there for 15, 20 years or 20, 25 years and coming back, then you will be understanding that the investment what you made is not going to help you, but it is helping only the mutual fund or insurance distributor or the manufacturing companies. So this is a sad state of affairs in India, and NRIs are the most exploited people, I will say, as far as personal finance is concerned, because you don't have time. When you are coming here for 2 or 3 weeks vacation, when you go to the bank, I have seen with my own eyes, the bank relationship manager is mis-selling the wrong products to the NRI who is there for a week vacation, who don't want have that much of time, so will blindly sign. Forget about relationship manager here. Now there's a recent trend. Even some of the NRIs, or they are coming from here and becoming NRIs there only to exploit the NRIs. So it is happening in a big way in Middle East, where it is mutual fund and insurance agents are coming there, camping there, and selling wrong products. It is happening every spectrum of personal financial products everywhere in the world. So unless you take interest, you will be taken for a ride. So please careful with such things in your personal finance. Let us know each other. I'm sure all of you, most of you people will be married, some youngsters will be there, but normally bachelors will not be interested in the personal financial matter to some extent. And I'm sure all of you are insured. When you ask me, are you insured? I'm not sure 99% of the people will be telling that yes, I am insurance. But the question is whether you are adequately insured, whether insurance what you're already having is adequate. What do you mean by adequate insurance? So I will take an example. Say if I die today, okay, let me die, because I know if I take example with any of you, you may not like it. So if I die today, and if my children can study in the same school where they are studying, or where my wife and children can stay in the same house where they are staying now. And they can do the shopping in the same shopping mall what they are accustomed to. And they can maintain the same standard of living till the time of their life, partially using my net worth and partially using the insurance money. Then I will say I am adequately insured. That means if I die today, some money should come from my existing liquid savings and some money should come from the insurance company. So that money which has to come from insurance company, that is called adequate insurance. You may not need a life insurance at the age of 55 or 60 or after creating enough liquid assets. But you definitely need a life insurance at the age of 35, 40, 45, because at the time you are creating asset for your family. But if something happens at that time, then family will be in trouble. So till the time you generate that type of a revenue, that type of an income for your family, you need life insurance. The question, do you invest in stocks and mutual funds? I know that most of the people in this group are investing either in stocks or mutual funds. Some people have become very good stock investors in the last 1 year after the market crash. But don't think that you'll be able to perform the same way for the next 15, 20 years. We cannot be better than a smart fund manager. So mutual fund will be better. So, but how many of you are investing in mutual fund? That is the question. The last one, emergency fund during pandemic. I've seen last year when the first wave of COVID struck, people become panic. I was sending regular WhatsApp messages to my clients, and I know out of all people, 5 to 6 people, they don't even have the money to manage the next 3 months. They have to pay the EMI, they have to pay the school fee for the children, they have to pay for the karka karcha. But even if you are earning 2-3 lakhs per month, you don't keep enough liquid asset to take care of 2-3 months expense, that means there is something wrong. That is where an emergency fund comes into picture. I will explain all those things in the coming slide. Let us get into introduction part. I know a good number of people are my clients who are already joined here, and they have invited many of their friends also. So for the benefit of everyone, because otherwise you'll be thinking, who is this person talking? Because nowadays the trust factor is lacking everywhere. Whether it is personal finance or in life, it is there. In the case of personal finance, it's more. People are scared of listening to anyone. In the sense, if I am asking you to invest here, you should definitely ask why. If you don't ask that question, blindly invest, you can be taken for a ride. This is the way the trust factor is lacking in this industry. Let me tell you, I started my career in the year 1987 with the Life Insurance Corporation of India. I joined in the clerical cadre and worked for 11 years with LIC. I left LIC in the year 2000 when the industry opened up for private sector. I was heading Egmore branch of LIC of India at that time in Chennai. Then I worked for next 3 different private companies for the next 10 years. Kotak Life, Bajaj Alliance and SBI Life. And in the year 2010, I was heading corporate agency broking channel in SBI Life in their head office in Mumbai. And I resigned that job and I started my own firm, that is Win-Win Financial Planners, in 2010. Let me tell you why I left my job at the age of 42 and started my own firm. Though I was getting good salary, getting good incentives, lot of foreign trips, lot of recognition, and my agents are making good money, my team members are making good money, promotion ads. At the end of the day, I realized whatever I am enjoying is part of the money given by a poor investor sitting in a remote village in Bihar or in Tirunelveli in Tamil Nadu. And at the end of the day, it started pricking my conscience. So whatever money I am getting is coming not from the straightforward way, because the products what we are selling is not good. Even sitting at the senior level in the company, I was unable to do anything against the wrong selling because the regulator was silent. The insurance companies or the mutual fund companies or credit card or anything in that matter, they were all interested in making money only for the distributor and handful of employees and for the company themselves. So I decided, let me leave, and I started my own firm in 2010. In the last 11 years, I have helped thousands of people, either through as my client or through the social media or through the friendly talk, in getting out of their financial mess and invest in the right products so that they will protect their financial interest and their family will be in good shape at the time they retire. And I feel very happy in the last 11 years in doing this job. My income has come down drastically compared to what I was earning there, because in the first 3-4 years there was no income. But slowly it's picked up because it was a new concept in India, because it was a fee only financial planning model. And in 2010, nobody knows about this. And now in 2021, I can proudly say there are only 20 to 25 people in India. And we have even a website called the feeonlyindia.com, where, like me, there are 20 to 25 people are listed. All of them are doing a noble job of giving advice and charging a nominal fee without selling any product. So you can contact any of those financial planners listed in feeonlyindia.com. They are all genuine. They don't sell any products. Other than that, if you go to any distributor or any agent of any company, always think twice, because he may be selling it for him, not for you. Let me get into the topic. I'll be using a way of explaining the myth and then explaining, decoding the myth. So let me start with the life insurance. I'm sure all of you are having a policy. Look at the policy certificate. In some unit-linked policies, you can see that you are paying 1 lakh rupees premium in a year, and the insurance value is 5 lakhs. So what is the meaning? If something happens, that means in simple terms, if the policyholder dies, the nominee will get 5 lakhs. Whether the 5 lakhs is sufficient now in the current condition? No, it will not even give a decent burial in today's condition. So this 5 lakh policy is of no use to you and your family, but you are paying 1 lakh premium. Forget about the people who are earning good money, working in very big job and all those things. But a common man working in the Middle East as a construction worker or somebody, paying 1 lakh rupees premium in a year is something very big. And the family is insured only for 5 lakhs. So it is not a good product for him. So don't invest in such products. So you should have policy where this, instead of this 5 lakhs, it should be 1 to 2 crore. And instead of this 1 lakh, here it should be some 15 to 20,000 rupees. That means you should have a good cover at a lower premium. But the type of policies we have in India, those type of offer is very much limited. So don't buy this type of policies. So whatever policies you're having, you just have a look whether it is worth to keep it or not. It is not beneficial for your family. And let us say now the policyholder is not dying, you are continuing living up to the age of 60 and the policy matures. So what is the return you are going to get? Believe me, if you get 4% return in the next 20 years, you should be happy. Because even the bank FD rate has come to 5%. When the bank FDs were offering 7 to 8%, then itself the return from insurance policies are reduced to 4%. So even now, the insurance industry is continuing with such a huge incentive system of very high commission to the agent. And normally, the end user, that is the policyholder, is going to suffer the impact of the reduction in the interest rate in the country. So don't think that if you're buying an endowment or money back policy now, you will get even 4% return. So the policy which you have taken 10, 15 years back, you may get 4%. But the new policies you are going to take, you may not get even 4%. So this is not good for you. The last line is very, very important. Why banks are pushing insurance products? NRIs are exploited by NRIs in the Middle East. I heard that a team from India have gone to Middle East and they have joined the distribution companies there, and they are going to the NRIs, especially the people who are working in the lower level as construction workers, laborers and all, and they are selling this type of wrong insurance products from the Indian companies. So the NRIs are going there to exploit our middle class NRIs there. So don't buy such products without knowing what is what. And what is happening in the bank? You go to a bank when you come to India, or even you are getting very affectionate mail from the bank. Dear investor, we have been selected as a very privileged customer of our bank, and we are very happy to introduce a product which is offered to only exclusive clients like you. So you are gone very flat. You are feeling that, okay, you are reaching somewhere in your life. The moment you get a call like this or a mail like this, be sure that you are getting into danger. Why? Banks are pushing wrong products. Why banks are pushing wrong products? If you look at the balance sheet of any bank in India now, the main income, earlier days they were getting income by giving loans and getting the differential interest. But now, a sizable income of most of the banks, whether it is a government bank or a private bank or a foreign bank, most of the banks are having a very big income coming from the third-party distribution. That is what they call it as. Today morning, I have seen MD of a private bank, leading bank in India, was talking. We are planning to increase it to 18%. So what is the meaning? They are planning to sell more wrong products. So what is happening in a typical bank? There is a concept called a relationship manager. When you are having 4 or 5 lakhs in your bank, you will get a relationship manager. But the moment you have 20 to 25 lakhs in your bank account, you will get a wealth manager. So you are thinking that you are getting some favor from the bank. No. I can explain in a simple way, whether you like it or not. A relationship manager goes to Pattaya every year, whereas the wealth manager goes to Macau twice in a year with the family. I was a party to it. I visited 10 foreign countries in my last 5 years of my assignment with the last insurance company. And it was the order of the day. Even now, most of the companies are having that type of contest, either in the terms of foreign trades or whatnot. So be very careful. There's no need for you to depend on a relationship manager. You can learn these things in your life, in your interest, and avoid such people. Don't visit the bank branches as far as possible. Try to do everything online. If you only visit the bank, it should be only for FD, RD, or for a locker, not for anything else. Nothing is worth. So be very careful with the bank people, otherwise they will make you bankrupt. Every day morning, the bank manager give target to the relationship manager, and their salary, incentive, everything is depending on the revenue what they generate out of selling products, and they get maximum revenue by selling wrong products, so they sell it. It is the young employees coming after fresh MBA. We can blame them from their point of view, but at the end of the day, you have to protect your pocket. Be careful. What is the reality? This is the only product which is worth in life insurance. That is called term insurance. What is term insurance? All of you are familiar with the car insurance or bike insurance. Let us say I am insuring my car for 5 lakhs rupees and paying a premium of 20,000 rupees this year. So what will happen in the next 1 year? If there is no accident or if my car is not stolen, I will lose my premium of 20,000 rupees. But at the end of the year, if nothing happens, happily I am renewing the policy by paying another 20,000 rupees premium or even 1,000 rupees more. Why? I am happy, nothing happened, thank God. I will pay again because I don't know whether next year the same thing can happen. Accident can happen, theft can happen. Same thing in the case of term insurance. If I take a term insurance now at the age of 53 for 1 crore and pay 20,000 rupees annual premium, next year this time there can be two situations. Either Melvin is alive and I have to pay the next premium. I will thank God and pay the premium happily because I have lived for 1 more year. Situation number 2, next year this time I'm not there. That means I died. But somebody else will be thanking, that is my nominee, will be thanking God for getting that 1 crore. Emotionally, the family lost the breadwinner, but at least the insurance company gave that 1 crore. With that, the family can maintain the same standard of living to some extent. This is the purpose of actual insurance. So the only insurance is term insurance, which you should do. You can buy it online. That is, if you can purchase this policy also online without any agent, then your premium is much less. That means you'll be able to purchase the same policy at a lesser cost. So you need not buy this policy through an agent. Even the term insurance policy you can purchase through online, so that you will be able to get the policy at a lower rate. Now let us see the premium. You can cover your life for 1 crore just with a premium of around 1,000 rupees per annum. If you are in the range of say 30 to 35 to even up to 40, your premium will be in that range. That means for a 1 crore policy, the annual premium will be around 12 to 30,000 rupees. That is around 1,000 rupees per month. There is no maturity benefit in this policy. Don't expect that you will get back something. Like in the case of car insurance, only if there is an accident, you will get the money. Otherwise, you lost the premium. Same thing in this case also. By paying 1,000 rupees monthly, I cannot expect that I should get 1 crore on maturity. So I'll be getting only the, not I, my family will be getting the death benefit. There is no maturity benefit in this policy. Now, this is the only way to provide a huge amount to take care of the family in your absence. Why I am telling this? I have seen in the last 30 years, I have seen around 50 families, either during my LIC days or through my private company days or through my financial planning days in the last 10 years. So in the 30 years, I have seen around 50 to 55 families where I was involved with the claim investigation, settling the claim, issuing the policy of different products and different companies. And I have seen out of these 50-55 cases, 10 to 15 people were really benefited because they have taken enough insurance. Others go to the small amount of 1 lakh, 5 lakhs, 10 lakhs. So they are not benefited by the term insurance. Sorry, by the life insurance, because they were taken normal endowment and money back type of policy, which is not good. So purchase a term plan which will give a huge amount of coverage at a lower premium if something happens for your in your active life. Now coming to NRIs, whether it is worth buying outside India or in India. In the last 10 years, I feel it is competitive if you buy in India. Because what I've seen, most of the companies abroad, including the Middle East or the European countries, they don't offer plain term plan. They bundle it with so many other products. They will bundle it with the critical illness policy. They will bundle it with the personal accident policy or a ULIP type policy, which is there in India. And they give very long time, say up to 70, 75, 80 years and all. To be frank, there's no need for insurance coverage after 60 because a typical Indian will retire by 55, 60. And after that, there is no need for term insurance. So if you purchase a policy which is covering you till the age of 75 or 80, you'll be paying huge premium from day one. So as per my studies, I feel the term insurance premium is cheap in India, so you can purchase it from India. Second thing, if you buy from India, if something goes wrong, then claim settlement for your nominee will be easy, because I don't think our family will be comfortable in dealing with a company which is in the Middle East or in Germany. So in that way, it makes sense to purchase a policy from India. You can purchase it online when you visit India. Now, some companies allow you to purchase it even when you are there. They arrange medical checkup there and all at your cost, but there can be administrative hassle. It will get stuck. So I personally prefer you purchase it during your visit to India. So what I tell all my clients, contact me 2-3 weeks before your trip to India so that I can guide you how to go about and purchase the policy when you are coming to India, because the insurance company will arrange medical checkup, everything, and you will get the policy also by the time you go back to your country of birth. So that is about, these policies offer global coverage. So even though the policies are offered from India, whichever part of the world you go, the policies offer global coverage. That means even if the death happens any part of the world, the life insurance company will honor the death claim. So there is no issue with that. So that's about life insurance. Let me sum up in few words. A person who is earning, who is having financial dependence like wife and children, definitely need life insurance. But the only life insurance he needs during the working life is term insurance, where there is no maturity benefit, but offer huge death insurance coverage at a lower premium. You can purchase such a policy now without agents online from Indian companies at a much competitive rate. So the cost of insuring your life for 1 crore Indian rupee will be around 1,000 to 1,500 rupees depending on your age. And these policies offer global coverage, so you can purchase it when you are coming to India. So I will take questions at the end of the session, because now all of you are in a muted stage. So after the session, we will unmute. You can raise your hand using the option available in the Soho platform. Then we will unmute you. Then you can ask the question, because some of the questions will be answered during the presentation itself. So that is why I am going non-stop. So don't think that I will not listen to you. I will take all the questions at the end of the session. Now let us get into the next topic, general insurance. In general insurance, there are many topics. I'll be covering only the health insurance part here today. There are a lot of complications in health insurance. It's more complex than life insurance. So let me explain the most common complicated terminologies in health insurance. One is copay. Copay stands for co-payment. In simple terms, if you have a policy of 5 lakhs, and if you have a hospital bill of 1 lakh, let us say you are admitted in the hospital for an accident or something in India, and you have a bill of 1 lakh. When you apply for the claim, the company will not give you the full amount. They will give you only 80% if the co-payment is 20%, or they will give you only 50% of the claim if the co-payment is 50%. So this co-payment is mainly applicable for senior citizens or if you have any health issues, not for all the young people like youngsters who don't have any problem. So they can purchase policies even without any co-payment. But the moment you become old or the moment you have any health issues, then the insurance company will start dictating terms. They will say, we will not be able to give you the 100% of the claim. We will give you a policy, but if there is a claim, we will give you a 30% or 50% less. Balance you have to pay from the pocket. So if you look at a very common policy like Star Health, Red Carpet policy, in that policy, you will get only 50% of the claim in case of pre-existing diseases, or they will give only 70% with the 30% copay in case of other diseases, other claims. So it is better to avoid such policy. But think about a person at the age of 60 or 65 who is having many health issues, other companies now. So the internal congenital diseases were not covered earlier, but now with the latest change by IRDA, internal congenital diseases are covered. So if I have gone for my surgery now, instead of 11 years back, I'll be getting the claim. So that is how slowly things are emerging in India. So more and more diseases are getting covered in the insurance policies. So now internal congenital diseases are covered, but external congenital diseases are not covered. That is how it is going now. Another condition called sublimit. Sublimit. Say you are taken a policy of 5 lakhs and you have a particular disease. What insurance company is doing, they don't give the full amount in such claims. Say most common thing is expenses related to delivery. Even if you have a 5 lakhs policy, and in case of a delivery related claim, in the case of normal delivery, they pay only 50,000 rupees. Or in the case of the cesarean section, they give only 1 lakh. So such things are very common nowadays. Similarly, there is another catch in the case of the room rent sublimit. That's the biggest catch. So if you have a 5 lakhs policy, someone is talking. Can you please listen here? Please keep yourself in mute form, and I will give you time to ask questions at the end. Otherwise, it will be disturbance for everyone. Okay, thank you. So in the case of sublimit, room rent sublimit is very important. Let us say you have a 5 lakhs policy, and unfortunately, somebody in the family had a serious heart attack and was admitted in the hospital for 2 weeks. And the bill has gone to, say, 3 lakhs. Let us say you are admitted in a Bombay hospital where the room rent is 10,000 per day. And if your policy of 5 lakhs is having a sublimit of 1% in the case of room rent, then even if your bill is less than this, you will not be getting the full claim. You will be getting only 50% of the claim if you go for a room rent of 10,000. In simple terms, if your policy is for 5 lakhs with a room rent sublimit of 1%, you are not eligible to go above 5,000 rupees monthly rent, daily rent. And if you go for such a room, it's not only the difference in room rent which will be deducted, the entire bill will be deducted proportionately. That means if you go for such a room, instead of 5,000 rupees daily rent, you go for a 10,000 rupees daily rent, and your actual bill is 3.5 lakhs after the heart attack and all, you will not get 3.5, you'll be get only 50% of that, because instead of a rent of 5,000, you are going for a rent of 10,000. So each procedures in most of the hospitals are billed according to the room rent, so type of the room they are going after the procedure, like surgery. So that's the biggest catch. So don't purchase a policy with the room rent sublimit. I have written an article and I have done a webinar recently on life insurance and health insurance. It is available in YouTube also. You can check that. There I have explained in details why you should avoid a policy with such sublimits. So don't purchase a policy with sublimit. Next one is the waiting period. What is waiting period? You can see now in India, there's a lot of rush for purchasing COVID policy after seeing a lot of COVID. But don't think that you can purchase a policy today and tomorrow, if you have COVID, you can claim. Earlier in the COVID policy, they were giving a after a waiting period of 15 days. But now they also changed it to 30 days. So in normal health insurance policy, you cannot claim from that policy in the first 30 days of taking the policy, except for accident. So if you have a policy you're taking today and you're claiming it for an accident case, tomorrow you will get it. But for a heart disease or for a treatment for diabetes, knee replacement and all, you will not get it. So what is happening in the case of normal hospitalization, after 30 days, the policy will come into force. But there are certain diseases which will be covered only after 1 year, 2 year, 3 year, and even 4 year. So depending on the policy, depending on the diseases, there are waiting periods stretching up to 4 years. So don't think that your policy covers all diseases from day one or even in the year one. It will not happen. So when you are purchasing a policy, check all those conditions. As far as possible, purchase the policy without co-payment, without exclusion, without sublimit, and with a minimum waiting period. This is again a big question for all of you, especially when you are NRIs. You need a health insurance, even if you have one from your employer. Yes. As long as you are working there in your company is giving you health insurance in the country of your residence. But what will happen if you change the job, or if you lose the job, or if you go for a better job in a startup company where there is no insurance coverage, you won't pay the employer. So in such case, what will happen? Question number 1. Question number 2, what will happen? You leave that country and come back to India maybe at the age of 55. Then who will give you a policy? No insurance company will give you a policy at the age of 55, 60, because I have not seen a single person after the age of 40, 45 with a normal BP or cholesterol or sugar. The incidence of such lifestyle aberrations are very common. So you need a health insurance coverage right now when you are young. So purchase a policy, even if you are in another country, even if you are having a very good coverage from your employer in the country of your residence. You have an accident cover and critical illness. This is again a second and third level of protection. Accident policy covers you in the case of accident and death, and in terms of disability. The term insurance policy, which I explained earlier, will cover only death. But if there is an accident and if there is a disability like coma or losing one limb or two limbs and all, then you will not get anything from the term insurance, but you will get an income or a lump sum payout in the case of personal accident policy. So it is better to have a personal accident policy also. Critical illness policy is again the next level of protection. That is, now with the incidence of lot of critical illness like diabetes, cancer, heart attack and all, what people are thinking that going for a hospitalization policy alone is not sufficient, because in such policy you are getting only the money what you actually spent in the hospital, whereas after the critical illness you may not be able to work in the same way. Your income may be reduced, maybe 2-3 years you may be unable to work. So during that period your income will be affected. So to protect such things, you can purchase a critical illness policy. So in this policy, if you have any of those critical illness disease diagnosed, immediately the insurance company will pay you the lump sum payout without insisting on any bill. So this is the third level of protection as far as health is concerned. Do you have a health policy for your parents? Very, very important question. People will be asking, my parents are now 60, 65, and the insurance premium is coming to 35,000 rupees or 40,000. Can I buy a policy or why not avoid it and invest that money in an RD and accumulate money? It will not work out, because parents are now 60, 65. You may get a policy even at a higher premium. Think about a situation 10 years down the line or 15 years down the line. Parents are going to live up to 85, 90. So you cannot ignore the parents' policy at the age of 65, 70, thinking that the premium is high. Then you will not be able to purchase a policy a couple of years down the line. So it is always better to purchase a policy for parents also now. In this case, for parents, you may get a policy with the co-payment, exclusion and all. So try to get a policy with the minimum exclusions. That is the only way you can protect your pocket. Otherwise, you'll be spending huge money for treating parents also. Right, yeah. Another thing is grace period. See, in the case of life insurance, all of you are aware about what is called the grace period. So, for example, today we are on 27th of August. Your life insurance policy premium is due today, 27th of August. You can pay this premium in the next 1 year. That is up to 27th of September. You can pay the premium without any interest, and there will not be any risk. That means even if there is any claim, insurance company will pay the death claim. So there is no problem in paying the premium during the grace period. But in the case of life insurance, health insurance, there is a catch. Let us say now you have a health insurance policy and you are paying the premium for last 10 years. And today is the premium payment date. Unfortunately, you are very busy and you forget to pay the premium, or you are there anyway, grace period is there. So some companies give 15 days grace period in case of health insurance, some companies give 30 days. But let us say you forget to pay the premium during before the due date, and you are continuing the normal life, and after 1 week you realize you missed the premium. Anyway, grace period is there, you are going to the insurance company to pay the premium. Let us say in the unfortunate situation, while going to the insurance company, 1 week down the line, you had an accident and you are in hospital for a week. Even though your policy is there for last 10 years, you will not get claim from this policy. Normally, agents will not tell you this. So don't think that the grace period in health insurance is something beneficial for you. It is not beneficial for you, because the grace period is only an option to continue your policy without losing your pre-existing coverage and without losing your no claim bonus, etc. in the existing policy. But during the grace period, if there's a claim, insurance company will not pay the claim. So don't wait for the grace period. Pay the insurance premium, preferably 1 or 2 weeks before the due date, and keep the policy in force always. So don't use grace period in health insurance. It's a policy now for your post-retirement days in India. Why? By the time you come back to India at the age of 55, 60, no insurance company will give you a policy. Purchase it now. But if you are purchasing the policy now, don't think that the treatment taken in your country is covered. It is not covered in most of the policies. So what I am recommending this policy is only for your post-retirement days in India. If you are coming on vacation in India and if you are in hospital, that bill will be payable. But you go back to Dubai, then there is a health issue, you will not get any claim from this policy in India. But anyway, that will be taken care by your coverage in Dubai. And there are some policies in India started giving a limited cover for the treatment taken outside. But I have done a cost-benefit analysis. I feel this not worth. That means don't purchase that policy which is offering global coverage, because the premium what they are charging is not worth the benefit what they are giving. So it is not worth. So have a policy in the country of your residence. Same time, purchase a policy for your long retired life in India. Otherwise, by the time you come back, you may not get a policy and you will not be able to purchase a policy. And living without a policy in India for 30-35 years will be very difficult, because the treatment cost in India is also increasing, like most part of the other part of the world, like in developed countries. Treatment I already told. So that's about health insurance. I have done. Let me do a recap. You need a health insurance policy even if you are in other countries, because you are going to return to India. But if you are going to settle down in that country, for sure, then you do not need a policy in India. But if you want to buy a policy in India, don't delay it and purchase at the time of retirement. Purchase it now, because buying a policy at old age may be difficult. Try to purchase a policy without co-payment, without exclusions, without much waiting period, and other terms and conditions. Those things are possible only if you are buying a policy when you are young. If you are purchasing a policy now when you are healthy, that policy you can continue lifelong. Nobody can deny that policy renewal. That means, in my own example, I had the policy of 5 lakhs. I had the brain surgery. I can continue my 5 lakhs policy lifelong. But now I cannot increase that 5 lakhs to even 6 lakhs. That is a cash. So in my existing policy, all future diseases will be covered, but I will not be able to increase the coverage. So the only way to protect or purchase a decent coverage for your retired days will be to purchase it when you are young, irrespective of the premium cost. And purchase a policy for your parents also, even if there is a high premium, because purchasing the policy at a later stage will become impossible. Otherwise, this can be costly mistake affecting your pocket. And ensure that not only you, immediate family and parents, all your extended family, brothers, sisters, brother-in-laws, if possible, the maid at home, the driver at home, even your neighbors. Because what happened last week, I got a call from Chennai from one of my friend. He is in hospital. The bill was going to 7 lakhs. Heart attack. Wife is selling no money. So all friends joined together, pooled money. So how many people can help like that? It's very difficult. So ignorance cannot be an excuse. Purchase a policy so that you will be having enough money to take care. Otherwise, it will affect your pocket, even if it is not going to be immediate family. So try to spread the news. Everybody should be decently insured. Let us get into mutual funds. Here are a lot of myths. This is a common myth. We can see advertisement, new fund offer. Just now, 10 minutes back, I was answering a client who was asking me, can I invest in so and so advantage fund because it is offered at 10 rupee. For the last 2 months, we can see most of the funders are announcing a particular type of funds which they are telling is very good for you at this season. Very good for someone, not for you. Good for the agent, good for the mutual fund company. So I will explain that in the coming slide, the 10 rupee NAV and 200 rupees NAV. So what is NAV? Net asset value. So the agent will come and tell you, we are launching a new fund. You will be getting it at a 10 rupee NAV, whereas the old fund in your fund house is worth 200 rupees NAV. So what is the meaning? If you invest 1000 rupees, in the case of a 10 rupee NAV, you will be getting 100 units. Okay, by 1000 rupees, you will get 100 units. Whereas if you invest the 200 rupees NAV fund, you will get only 5 units with 1000 rupees. But believe me, there is no difference between these two. I'll come to that later in the next slide. Another advertisement by the mutual fund company. We are going to declare dividend on 31st of August. Rush and invest now. Do you think the mutual fund company is so magnanimous, better than our parents calling you and asking you to invest before dividend rate so that will benefit your family? Do you think they are doing something good for you? No, there's a catch. I'll come to that later. Another one. Mutual fund agents will come and tell you, sir, this is a closed-ended funds. You can make good money in 3 years. Do you think it is correct? No. We'll go to that next. So all advertisement captions. Another one. This is what is a normal mutual fund agent is telling. Sir, we are not getting any commission. We are doing it for service. Let me explain in the Mumbai background. An agent is traveling 2 hours in a local train to come to your office and get your signature in that mutual fund form, doing it free without getting any commission. That is what he is telling. Is it true? Do you think anybody will do something like that? No. I'll explain that later. Why he is coming to your office. Another one. Mutual funds are risky. This is what is normally protected by the life insurance agents. They will come and tell you, sir, LIC is better or insurance, XY insurance is better because at least you will get something. That is in the case of mutual fund, you can lose some money. Partially true, partially false. I will come to that in the next slide. Let us see the fact. 10 rupee NAV. I will say it is a fresh MBBS doctor. I know some doctors are also already listening to this. Everybody know that. After MBBS, somebody will need experience, so he will go and join in a hospital, a small clinic. So what is this? He wants more and more patients to get experience because with an MBBS degree alone, he will not be able to treat properly. You should gain experience. So I will not blame if I'm going. Sorry, I can go to such a doctor if I have a normal flu or such diseases. But if I have a chest pain in the night, I will always prefer to go to a cardiac doctor or at least an MD doctor with a 15-20 years experience. Because life is precious. I don't want to play around with a fresh MBBS doctor. Similarly, in the case of a mutual fund, when you are investing in a 10 rupee NAV new fund, that means this is a new fund started yesterday or last week or starting now. It is not having any track record. Whereas the mutual fund unit having a NAV of 200 rupees, that means this fund also started with a 10 rupee NAV years back and it has done very well and it has gone through many critical phases of economy like 2000 crash, 2008 crash, and last year COVID crash and all. In spite of all those things, that fund has performed well and it has come to a net asset value of 200. That means this fund has already seen markets ups and downs. So investing in such a fund is much better compared to investing in this 10 rupee fund. Then why NAV of these agents are pushing this product? That's the catch. That's a rule which allows the mutual fund companies to give slightly higher commission for selling new funds. One reason. Number two, mutual fund companies find it very easy to generate more revenue by giving advertisement like this 10 rupee. So these are the reason why mutual fund agents are pushing this 10 rupee NAV product. So don't invest in this 10 rupee NAV product. Always go for experienced funds or which is there in the system for a couple of years at least. So avoid new fund offer. This is called NFO. Another one, dividends. Again, big advertisement. Dividend on 31st of August. 10 rupee dividend on your NAV. Let us imagine what will happen to the NAV next day. So in mutual fund, when you are investing, they give you two options. One is dividend option, one is growth option. When you are investing in dividend option, they will, mutual fund company will give you dividend once in a while. That is why they are advertising. They will say that you will get X amount, so and so date. That is true. You will get. Let us think about what will happen the next day after giving the dividend. Let us say net asset value of this particular mutual fund you are invested is 200 rupees today, and they are declaring a dividend of 10 rupee today. Next day morning, if you can check the NAV, automatically it has reduced to 190. So what is the meaning? From your 200 rupees, the mutual fund company has given 10 rupee back to you as dividend. So it is not their money. It is nothing but your money coming back to you. When? Not when you want, when they want. So it is a way of fund management to attract more and more investors, telling that they are giving something extra. 90% of the people don't understand what is dividend. They are thinking they are getting it something extra. Even educated people are falling into this type of wrong selling. So don't invest in dividend option of mutual fund. Invest only in growth option. In the case of growth option, the NAV will keep growing from 10 rupee, 20 rupee. Like in the example I told you, they will become 200, 300, 400 and all. And whenever you want to redeem, you can redeem as much as you want on the day when you want. So in dividend option, they give the money when they want. Whereas in the case of growth option, you can demand money whenever you want. So don't invest in dividend option. Another catch is closed-ended funds. So what is closed-ended funds? You can again see paper advertisement. We are offering a new fund for the next 15 days. After 15 days, it is not allowed for purchase. Then you will be able to buy or sell after 3 years. And this 3 years, you will get a huge return. That is what they will project. But what is the catch? In the case of closed-ended funds, if you are investing today in a 3-year closed-ended fund, you will not be able to take the money out before 3 years. So the fund management knows, the mutual fund company knows that your money is going to be with them for the next 3 years. Where it is going to be up or down, you will not be able to take it back. So what they do, they know that they can deduct the management charges for 3 years. So to attract the agents, what the fund companies are doing, they are giving this 3 years commission almost upfront, the beginning, to make the agents happy. So at the end of the day, all these companies want agents to be happy. So they make this type of upfront commission. Most of the full commission for 3 years will be paid upfront, so that agents will push this product hardly and they will come to your office and you will get your signature. But unless you have a very specific purpose for this particular fund, invest in that. It's better to avoid such fund. Better to invest in open-ended funds. So in the case of open-ended funds, you can invest whenever you want and you can withdraw whenever you want. So avoid closed-ended funds. Invest only in open-ended funds. So let us go to the commission aspect. Again, there's a myth. Mutual fund agents are not getting commission, but this is a fact. Insurance agents are getting commission only on the premium amount, whereas the mutual fund agent is getting commission on the accumulated amount. Take an example. Let us say you invested 1 lakh today in a mutual fund. Let us say next year, this time, the 1 lakh has become 1,20,000 rupees. So this year, when you are investing 1 lakh, the agent is getting around 1% on that. And next year, you are not investing. You are just keeping that 1 lakh there. Let us say it is a one-time investment. So you are thinking your mutual fund agent got commission this year, next year is not getting anything. No. Next year, he will be getting that 1% on that 1.2 lakhs. Even though you are not making an investment, even though he is not coming to you for any service, even he would have forgotten you, you would have forgotten him, that mutual fund agent is getting around 1% on that 1.2 lakhs next year, even without doing any work. Let us say third year, that 1.2 was reduced to 80,000. Market has crashed like 2008. There's a big crash. So your 120 has reduced to 80,000. What will happen? You are losing your money, at least on notional value, but the mutual fund is getting, agent is getting commission of around 1% on that 80,000 in that year also. So whether you make money or not, your mutual fund agent keep getting commission year after year. This is the reason why the mutual fund agent is coming to your office, traveling 2 hours, not to do any charity. Same thing with the banks now. Banks are also aggressively selling mutual funds. Good fund or bad fund, they don't bother. They are getting their commission. So in the case of life insurance, if you take an example of 10,000 rupees monthly SIP for 20 years, the agent will be getting around 4 lakhs commission in 20 years. Whereas if you are investing this 10,000 rupees in a life insurance policy for 20 years, that agent will be getting only 1.56 lakhs. So the insurance agent will be getting less commission, but mutual fund agent will be getting huge commission. But only difference is in the case of life insurance, that the agent get high commission in the initial years. So the moment you purchase a policy, a typical endowment type of policy, the agent will be getting around 35% commission in the first year, 7.5, 7.5 in second and third year, and 5% till the end of the term. That means you are taking a 30-year endowment till the 30th year. Even when you are paying the last premium, the agent will be getting 5% commission. Whereas in the case of mutual fund, the commission starts slowly. As until your amount increase, the mutual fund agent's commission increases drastically. So he makes a lot of money in the long term. That is why the mutual fund agents are aggressively selling SI, SIPs, and all those things. So if you can avoid that, it will be better. And second thing, this is what again insurance people are telling. They are telling mutual fund is risky. Yes, it is risky. Last week, one person contacted me. So what he want to double the money in 3 years. And the purpose is he want to go for a big apartment. So now he's staying in a 2 BHK. He want to purchase a penthouse. So he's having 1 crore now. So he want to double it, or if possible more than that in the next 3 years. I told him, sorry, please look for someone else. I cannot double or triple your money. Not even 3 years, not even 5 years in the current situation. So these things are nonsense. Don't think that it will make quick money. So SIP is better for long-term savings. That means if you want to make money in mutual fund, you should be patient. You should not have 2 year, 3 year horizon. If you're looking only for 2 or 3 years, go for only simple FD, nothing else. But if you're ready for long term, if you can wait for 15, 20 years, then mutual fund is the right place to make money. So mutual fund is risky in the short term, but mutual fund is not risky in the long term. So you should be patient enough to reap good benefits from mutual fund. During the 15, 20 years, you'll be seeing many crashes, many upsides. Some year will be very happy. This year, all the people are very happy. But next year, it can be reversed. Those things are common with the mutual fund investment. And as far as NRIs are concerned, try to invest from NRI account with a repatriation facility, because you'll be able to get it back to NRI account in case you need it for your children education abroad or something. It will be useful. So as far as possible, invest from NRI account in the case of mutual fund when you are, as long as you are NRI. Reality on the live case. How do you invest 10,000 rupees per month for the last 20 years in Aditya Birla Sun Life Equity Fund? Don't take it as a recommendation. Now it is not a performing fund. I taken as an example because this is a fund which is there for the last 20 years. So what would happen? You would have invested around 24 lakhs. So this 24 lakhs value, now you will be sitting at a 2.15 crore. Okay. So this data I taken in January. It is not the latest data. So now it may be slightly higher. So the CAGR return, compounded annualized growth rate return in this sample is 17.5, close to 18% for the last 20 years. That means, had you invested 10,000 without looking into the market, without worrying about the fund performance, without worrying whether the market will crash, will lose the money, 20 years, then you will be sitting with a 2.15 crore. That is a annualized return of 17.5%. Whereas no other investment has given this return during this last 20 years, including the real estate or gold or anything like that. Nobody has given 20% return. 18% return in the last 20 years. But going forward, the next 20 years, don't expect this type of return because India is developing. So once the industry matures, the return will come down. Be happy with the 10 to 12% return. But even that is not a bad deal. Then you are getting only 5% from FD. So that is about investing in mutual funds through SIP. Now, here again, you can invest in direct plan without agents. Like in the case of term plan, here again, you can avoid agents. What will happen? No agents means no commission. So who will get the benefit? You will get the benefit. How you will get the benefit? In terms of less charges. So in the case of a normal mutual fund, where you are investing through an agent, it is called a regular plan. But when you are investing without an agent, it is called a direct plan. So in the case of direct plan, the annual fund management charges will be less by around 1 to 1.5%. So agent will come and tell you, sir, the difference is only 1%. Yes, it is only 1%. But in the long term, that difference will be this much. So let us say person A and B. A is investing through an agent. He is getting 2.15 crore, what I told you. Whereas B, who is investing in the same fund, same 10,000, without an agent and a direct plan, he will be getting 2.5 crore. That is 18% more or 35 lakhs more. Then why you want to go through an agent? And now there are many platforms available where you can invest without any agents, almost like an Amazon cart. So if you are able to do all other shoppings through online, you can purchase mutual fund also online. Now almost the process become 100% online. Even KYC can be done online, even if you are abroad. So things are improving, especially thanks to COVID. Even video KYC is becoming very popular. So there is no need for you to invest through agent. No need for you to invest through bank. Another word of caution: when you are investing in the direct plan, don't think that the names like ICICI Direct or Axis Direct or HDFC platform, they are offering direct plan. No, they are very smartly put the direct there, but they are all brokers and they are all acting as a normal agent. So whether you are purchasing the mutual fund through an agent or from a bank through their platform, you are investing only under regular plan. If you want to invest in direct plan, there are two ways. Number one, you have to invest directly with the fund house website, or there are some platforms like Investa, Kuvera, MFU, Sarada, ET Money, Paytm, all those things. So those platforms allow you to invest through direct plan. So you can use any platform according to your comfort, but invest only in direct plan and don't lose that 80 to 80% to the agent. So that's about mutual funds. So let me sum up. In the long term, mutual fund can create good wealth, but you should be patient enough. You cannot expect positive linear return from mutual fund every year. So for example, if you are investing 1 lakh rupees this year, next year you cannot expect that 1 lakh will become 1 lakh 10,000 or 20,000. The 1 lakh can even become 50,000. It has happened in the past. I have seen 50% crash in 2008. But if you are patient enough and you are investing for a long-term goal, like your retirement, which is 20 years away, or your child's higher education, which is 15 years away, for such goals, equity mutual fund is the best option. And SIP is better, that is monthly systematic investment plan is better, because that will inculcate discipline. Every month you will invest irrespective of the level of the market. In the long term, you will definitely make money. Otherwise, people will default. So investing in mutual fund is good, and only thing it should be for the long term. So only thing required in the case of a mutual fund is one yearly review and make changes. If the fund is not performing well continuously for 3-4 quarters, then there is a reason to get out of the fund. I can tell you 11 years back when I started, all the funds of HDFC were the star fund for me. HDFC, DSP, Birla, ICICI, these are the star fund performance. Now, if you look at the total situation, most of these funds have gone out of limelight. Some of the fund managers, star fund managers of that time, they are now coming to CNBC channel and getting money from the channel and talking as if they are experts, because they lost their job because of the non-performance. So don't think that the same mutual fund will perform year after year in a better way. So there's a need for an yearly review and make changes. And that is the only monitoring record in the case of a mutual fund. There is no need to worry about the market daily and check the CNBC channel or ET Now and get tensed. That things will only increase your BP. That will not increase your mutual fund value. But persistence always will pay. So start SIPs and make money. Avoiding agents and investing through direct plan will make you still richer. Now, a lot of platforms available. There's no need to go through an agent. You can invest online and get better return. So, in the case of mutual fund, investing direct plan is a better option now. Let us get into emergency fund. What is emergency fund? Let us say something happens like job loss. It's very common nowadays. I'm talking unpleasant things, but that's the reality. Somebody is losing the job. He is not having money to pay the next month EMI. That is a very critical situation. So what happened? He has to sell gold, borrow money from the money lender. So many unpleasant things will come. He may be having money in the equity fund, because unfortunately the market is at a lower level. He will not be able to sell it also. So that is not the right way. So a person who is especially depending only on the salary, who is having commitments towards monthly expenses and EMI, SIP, etc., you should have some money readily available without looking into the return from that investment. That is called emergency fund. How much should be the emergency fund? As far as NRIs are concerned, I always suggest 12 months of monthly expense. That is 1 year expense. That means even if you lose the job, 1 year you should be able to stay in the same country and look for a better job or at least similar job, so that you will not have any problem in managing your EMI and continuing with your family expenses and the standard of living. So once you have the 12 months of monthly expenses in the country of your residence, don't keep that money in India. You have to keep that money which is accessible from your country. You can keep it in an NRI account provided you are able to redeem it there. Otherwise, keep it in the local currency, the local bank. Where to keep it? Keep some amount in savings account, keep some amount in 1 year FD or in the local bank, whichever country you are. So that even on a Sunday night, even when the bank is not working, you should be able to withdraw partially from the SB account using the ATM and balance next day you should be able to redeem after visiting the bank or online, or local bank, you have to go and withdraw the money. So they should have this ready. Without keeping this, and you should consider your credit card, EMI, etc. also while arriving at the amount. So without having this emergency fund, getting into investment will create problem. I am aware of someone, my friend was telling me last week, I am getting into a problem. So I had to think about investing in a mutual fund, which I invested 2 months back. It's the wrong practice. So you should have the emergency fund ready, then only get into the investment. Otherwise, your plan will go wrong. Emergency fund is a very, very important thing. You will understand it only when you see it the hard way. I have seen that with 3 to 4 clients last year when they had this issue of including job loss or transfer like that. Now we are coming to the bank account for NRIs. I know most of you are aware of it, but some of you may be new NRIs. So what will happen? Let us say typically a resident Indian is moving to another country. Let us take an example of going to Dubai. So what he has to do? Let us say he is having 3-4 savings account in India, 2-3 fixed deposits, some mutual fund investment going on. What he has to do? He has to inform the bank and he has to convert all his existing savings account in India to NRO account. It's called a non-resident external, ordinary account, NRO. So first thing you should do, actually, if you have a habit of keeping 4-5 unwanted accounts, better close down all unwanted accounts. You don't need more than 2 accounts in India, whether it is NRO or NRI. So I suggest you close down unwanted account which is not operative or which you are just keeping for namesake, and convert the other 2 accounts which you are going to keep it as NRO account. You can keep 1 account with the State Bank of India, which is the safest in the PSU sector, and you can have another 1 account in the new generation private banks, which will give you a lot of online facilities. So these are things which you have to do regarding your savings account. And once you move abroad, you can open an NRI account because NRI account will offer you tax-free status in India and all those things. So your main account once you move out of India will be NRI account. Keep the NRI account only for the local expenses in India, paying rent, insurance premium, etc. from India. Other than that, the major account will become NRI. Sometimes you may not be able to do these things at that short notice when you are getting a short notice and going abroad. And in such cases, most of the people, what they do, they will not do any change. They will continue with all investments. They'll go abroad. And after 1 year, when they come back on vacation, at that time, they will do all those things. That's also okay because even though technically it is not correct, most of the people do that. I am aware of many people who are keeping savings account even after 4-5 years. It's not technically correct. So you have to convert that account to the NRO and open an NRI account. Fixed deposit from NRI account is ideal for NRIs for the debt portfolio because interest is tax-free in India. It's more applicable for countries where there is no tax there also. So you don't pay any tax in the country of your residence and you don't pay any tax in India. So even if you are getting a less return from your NRI FD, that will be better for you as long as you are not paying tax here and there. Okay. And there is no, you can avoid debt mutual funds. I'd say as long as you are remaining as NRIs, you do not invest in debt funds because debt fund return is taxable in India. And there's a lot of complication regarding the TDS and all. So it will make your life miserable if you want to sell and all those things. So FD from NRI account will act as a debt portion as far as the NRI is concerned. Another thing is recurring deposit. I was recommending recurring deposit for all the NRI clients for the last 11 years for the debt portfolio. I don't recommend debt fund at all. And some people were very much reluctant to start the RD when the rate was 7 to 7.5% a couple of years back. But now all of them are smiling because now they locked in that 7 to 7.5% RD for 10 years. The RD offers duration from 1 year to 10 years. So someone who locked in an RD at a 7.5% or 7.8% for 10 years, even now he'll be getting the same interest, even though the actual rate has gone down to 5% now. But the advantage of recurring deposit is if you open an RD for 10 years, for the next 10 years, even if there's a reduction in interest rate that is not applicable to you, you will continue to get the same interest. So what you should do when the interest rate is low like this now we are almost on the bottom of the interest rate cycle. So in such case, when you're opening an RD, you should go for a 1-year RD, assuming there may be at least a 0.5% increase next year, not more than that. And when you are starting an RD, when the interest rate seems to be high, then be very smart, open a long term like a 10-year one. These things are the smart things you should do. So always have an eye on the interest rate and then decide. But once you come back to India, after retirement, or once you come and become resident Indian, then there is no meaning in keeping an FD because the moment you become resident Indian, then that FD interest will become taxable in India. Okay, like in the case of debt funds. But then debt funds become slightly attractive because there's a provision called the indexation. Indexation is a strategy given by the government to offset for the inflation in the country. So you will not be paying huge tax like in the case of FD interest, in the case of debt funds once you become a resident investor. So all the NRIs, once they move to India and become resident Indian, then as and when the FD mature, they can reinvest in debt fund instead of going again for FD and paying interest. And another type of account is FCNR, foreign currency non-resident account. Here you can see the interest rate will be much less, maybe 1.5 to 2%. But the advantage is that it is in a foreign currency. So what way it will benefit? You will benefit if Indian rupee depreciates. So you can look at the dollar value 10 years back and now. You can see dollar has strengthened. Same thing in the case of other currency, whether it's Australian currency or real or dirham or anything like that. Most of the other currencies are gaining momentum. So they are strengthening, or Indian rupee is depreciating. So India is doing it purposely to some extent because that will make our export very competitive, because India is a country which is exporting so many things, including software exports. So that is the way RBI is going to be like that only. So Indian rupee will keep on depreciating, may not be in the same pace, but still, of course, it will keep on depreciating. So if you want to benefit from that, then you can keep some amount in FCNR. The interest on that account will be less, but you will get benefit by way of depreciation in Indian rupee. But I don't recommend this for all the NRIs, because if you have a sizable portfolio in NRI account, then you can think about a portion in FCNR. Otherwise, it is not recommended. The slide to show you power of compounding, which I think all of you are aware of that. Somebody is saying, if you're starting at the age of 25 by investing 10,000 rupees per month in a mutual fund, assuming a 10% return, you can create 3.4 crore at the age of 60. Somebody was telling me yesterday, last week I conducted a session for Resident India. So he sent a message to me telling that, "Sir, thanks for the session. I opened an SIP for my son who just started his career." That is what you have to do. All of us have a moral responsibility to spread the word so that the things which you couldn't do when we are young, at least let them do. So I couldn't do an SIP till the age of, say, 30, 32. But somebody can do it at the age of 25, that is good. So spread the news. So let them make some money by investing the right thing. But if this person is not investing at the age of 25, and if he's starting only at the age of 35, then to create the same 3.4 crore, he has to invest 28,000 rupees per month. Instead of 10,000, he has to invest 28,000 rupees. The amount has increased. That is how power of compounding is working. Now, unfortunately, it is delayed by another 10 years, is 45. Then to create the same 3.4 crore, he has to invest 85,000 rupees per month, which has become almost impossible for him. That is how, if delay investment, then he has to invest more. In this case, he'll be investing 1.5 crore, is getting only 3.4. Whereas in the first case, he's investing only 42 lakhs, is getting 3.4, almost 3 crore extra. So starting early is the key. But at least start now. You cannot rewind the clock and become a 24-year-old person now. So whatever maybe the age, whether it is 50 or 55, start now. This is an important slide which covers most of the mistakes of the personal finance, which common man like you and me make. First one, people may not like it. Try to live within means. Avoid imitating others. Last week, my client was telling me, I'm getting 2 lakhs salary, but I'm unable to invest more than 20,000. I'm talking about a resident Indian only. Getting 2 lakhs salary, but he's unable to invest more than 20,000 in a month. So there is a catch. Where the money is going. He's having a small EMI, but still where the money is going. He's not answering anything. So both husband and wife, both were there in the call at that time. It's a joint call. After 1 week, he called me. At that time, he was alone. Then he told me, "Sir, you know what is the problem? My brother-in-law is a businessman, and he takes every month for jewelry purchase, and my wife is imitating. So what can I say?" I told him, "You continue, because you cannot spoil the relation of the family, but try to tell her this is not good, because this man is a salaried man. A salaried person cannot imitate a businessman. So it is up to you. But my feeling is this is where people make a lot of mistakes. Try to live within means. If you're getting 1 lakh salary, try to live within that. If you're getting 2 lakhs, okay, no problem. Live within that. But don't go for 5 lakhs. Identify the financial goals and start investing in the right mix of equity debt products. I've seen some people who invested everything in real estate. It is applicable to NRIs, because I have a person who invested everything in real estate. Now what happened? He's in India for almost 1 year. He was in India. Now he's going back to Middle East to work again for another 10 years. The reason, he invested everything in real estate. 2-3 projects have been held. 2-3 projects have been failed. Builder has run away with the money, and even whatever completed, he is not getting tenants because of the COVID. So the life saving, 100% investment in real estate. Now he's again back in Gulf to work for another 10 years at a lower salary. So please avoid such mistakes. Nothing at 100% is worth. Don't invest 100% in equity also. Highly dangerous. I know about a person who want to keep everything in equity up to the last day, and he's thinking as if you know when the market will crash. Again, totally wrong. You should have debt also in the portfolio. You should have equity. You should have debt. You should have gold. You should have real estate. You should have everything in the portfolio. One house to stay. There is nothing wrong in that. Decent house. You should have enough gold for the jewelry or some portion of investment. There is nothing wrong. But keeping everything in gold, keeping everything in real estate, keeping everything in equity is also equally wrong. So have a diversified portfolio. Use credit card carefully. I've seen many youngsters getting into this at a young stage. The moment they get the job, the bank will give a free credit card and they will start paying only the minimum amount due. What is the minimum amount due? If the due is 50,000, they will allow you to pay only 5,000 rupees. You're happy, bank is happy. Why bank is happy? They are happy because they are getting huge interest. What is the interest rate on credit card? The minimum rate is 36%. And it goes up to 48 and 50% in the case of a credit card loan if you withdraw cash and all those things. So don't get into the habit of paying the minimum amount due in the credit card. You will never come out of the credit card trap. My close friend committed suicide in Coimbatore 10 years back only because of this. I still forget. I cannot forget those days. So pay the full bill 5 days before the due date. Don't even wait for the last day. You should ensure that money is paid in advance so that there should not be any problem. And if you use like that, credit card is a wonderful tool. I'm using it for the last 20 years, but I never defaulted. I will not spend on card as if I will get the money in next 10 days. I will spend the card only if I have money in my bank account, which I am confident of paying before the due date. Otherwise, avoid. Next one is again more important, especially for NRIs. Avoid complex financial products. Simple products are better, but people don't believe in it. Any client coming, if you are an NRI, I am telling them you have to invest only in 2 simple products. One is 2-3 equity mutual funds and a recurring deposit. Don't invest in any fancy products. I'm going to explain some of the fancy products available, especially in the Middle East. But people don't listen. See, it is a problem with the age also. No? Some people like that. So at the age of 53, I always tell my children, idli sambar or roti dal is better for breakfast, for me at least. I'm sure. And most of the doctors also agree this is good. But even my daughters don't agree. They want some aloo paratha, paneer matar, something like that. Even I cannot even pronounce it. They feel that is better because everybody wants spicy. So when people want spicy, there are a lot of people ready to come with that. So when people don't want simple products like PPF or RD, all the banks or the insurance companies are coming out with the funny products. But the funny products are only to fool you. They are nicely fooling you. And a lot of lakhs of employees and agents are making good money at your cost. So try to believe simple products are always better. One more thing, there's a technique used by these people. They will come and talk some high funda language. This is what is happening in the case of mutual fund or insurance. The agent will come or the bank person will talk some high funda. You may be from an engineering background or you may be from a marketing background. But the moment he start talking on the high funda language, you started believing, consciously or unconsciously, that man knows better than you. It's totally wrong. He is making it complex only to create an aura and you can missell the wrong product. So that is what is happening. Don't think a 10th pass mutual fund or insurance agent is better than you. How can you believe that? And he is coming and telling he's an advisor. The visiting card, if you look at these people, they are telling wealth manager. What is the qualification of some of them? Just an MBA. What is MBA? If your father have 4 lakhs to pay to a third-rate MBA college, anybody can become an MBA now. So MBA is not losing value. Don't mistake when I'm telling you. I'm seeing this daily in and out. Last week, one of my son's mother at the age of 60 went to a bank to open a PPF account because she is getting into taxable rates. What happened? She come back with a ULIP policy of paying almost 2 lakhs premium for the next 15 years. And again, the same MBA wala with the tie and all, he fooled him. The poor lady come out. Luckily, her son called me after 3 days. I told her, you will immediately go and cancel it because it is possible. If you can cancel the policy in the first 15 days, it is possible. Again, another products. Some insurance policies, they will say, sir, in this policy, you will get a coverage up to 30 years. But you don't pay the premium for 30 years. You pay the premium only for 5 years. And you are thinking they are doing something good for you. No. Think about the time value of money. Time value of money, that means the bank is collecting the money in advance from you and they are investing their money. So they are getting your money at advance and they have made the same calculation and then that is how it is priced. So they are not doing anything better for you. So please open an Excel and see what is the return we are getting if you pay like that. Always start a PPF. Now it is not applicable to you if you are already NRI. because you cannot open a PPF account now, but you can continue your PPF account if you already have a PPF for the first 15 years. That means NRI, you can continue the PPF account which you already opened before becoming NRI for the first 15 years. After 15 years, you cannot extend it. So after 15 years, by the time you continue to be NRI, you cannot extend, but by the time you return, you can continue to extend it. And this is one of the wonderful products which we inherit from the older generation, which is tax-free now, not for the tax benefit alone, because this is the only product which will be available even after retirement as tax-free. Last year, I got a client, both husband and wife, both of them are having 1 crore in their PPF. I feel that's a best retirement I have seen in the last 11 years in my clients. This 2 crore is going to be totally tax-free for them. And they are from a government employee background. They have saved it with great difficulty, but this 2 crore will take care of their entire retirement life. And it is totally tax-free in their lifetime. No other product is giving tax-free return lifelong. Even if you have a Suganya scheme, once you become NRI, you cannot allow that technically. Some people are continuing that. But if any day government find out, then you will get only savings bank interest. But if your spouse is in India, then you can open an account in the name of spouse, where spouse is a guardian and your daughter is a beneficiary. Or even you can have a spouse PPF account also if she is India. So in the case of shippies, that is in the case of merchant navy NRIs, the option will be they can have PPF in the name of the spouse. But if you are in the other profession and you are an NRI, and if you don't have a PPF now, you cannot continue. But if you're already having a PPF, ensure that you're paying 1.5 lakhs for the first 15 years, because you cannot do that after 15 years. Then, other than this PPF, invest in 3-4 equity funds for the long-term financial goals. SIP is better for discipline. This is the only thing you should do. So you should have a PPF, and instead of PPF, in your case, you can have only RD, because you cannot open a new PPF and account invest in 3-4 equity mutual funds. That will do the job for you. Other than that, don't listen to any bank, don't listen to any advisor, and don't waste your money. It is your money going to others' pocket. Know your customer. You are aware that when you want to open a bank account, you have to do KYC. That means you have to submit your Aadhaar or PAN card, all those details. Same thing is applicable in the case of mutual fund also. So if you are a first-time investor, you're already there in abroad, and you're not open the account in mutual fund, then without doing the KYC, you will not be able to do that. So earlier, the condition was that only during your visit to India it is possible. Now what is happening? Some websites or even some of the organizations started doing video KYC. One thing like that is Coera, which I found out, they are doing video KYC in most of the countries. I think they are not doing it for US and Canada. Otherwise, for most of the countries, they are doing it. Or some other organizations, mutual fund companies are also doing. You can do the KYC online through video call. Then after that, once the KYC is updated, sitting in your own country, whether it is US or Canada, you can do all investments in all mutual funds online. KYC is a one-time process. So the difficulty is to get it done. After that, you can invest online without agent in direct plan using many platforms sitting in the country of your residence. So it's very simple. Yeah. One slide about SIP, we have already covered it. It's nothing but SIP is not a new product. It's nothing but a way of investing mutual fund. You are committing a fixed amount. In the case of RD, you are putting a same amount every month to deposit. Whereas in the case of SIP, the same amount goes to mutual funds. So when you invest, you will be getting automatically the money will be debited from your account and it will be invested, and you will get a statement within 2-3 days, and the money keeps accumulating. And it will bring discipline, because since you are investing at a particular day without looking at the level of the market, it will keep accumulating, and on the long run, this will be good for you. These are some special schemes for NRI. These are all wrong products. This one is very common among Middle East. Last week, one person contacted me. He has given me, this is a real case shared by him 2 days back. 48 months loan repayable. He is giving 2,10,000 dirhams loan, but actually bank will pay only this much, 205,800, because they deduct 1% towards insurance charge, 1% towards the processing fee. So even though the loan amount is 2,10,000 dirhams, they are going to give you only 205,800 dirhams. Then what will happen? They will recover it in 48 months by EMI of 4,860 dirham. So what will happen? They are telling loan is available at 2.8%. I still remember 11 years back when I started my practice, 90% of the people from NRIs, especially the Middle East, they were having this type of loan in the portfolio. This loan makes sense only if you have gone abroad by selling some gold or selling some land, or you have taken some huge loan from the money lenders here in India, and you have to pay back that money immediately. In such case, you have no other option. The moment you go there, you will get this loan. You can close that loan and you can clear it in the next 48 or 36 months. That makes sense. But once you become financially stable, once you work in that foreign country, then thinking that your interest is only 2.8%, taking this loan and investing it in India in an FD, you are getting 5%. You are thinking you are gaining, but actually interest on this loan works out to 6.3%. You can simply go to an Excel calculator, okay, EMI calculator, and see keying the data. 205,800 is the money what you receive, not this money. You are getting only this much after this thing. Put this money as the payment for the next 48 months. You will be getting this is our interest rate. So actual rate of interest is 6.3%. Whereas they are thinking that you are paying only 2.8%. I know some people who are taking this loan because they are telling this is the only way they will be disciplined. Okay, so they are thinking this is the only way to bring discipline in them and doing that. It's not good. So don't think of taking this loan and investing. It is having two impacts. Number one, you are not getting that high interest what you are planning because your action rate is more because you are paying through EMI. Second thing, if you go for such a loan, you keep on paying the EMI, you don't have money to invest in mutual fund. So what will happen? You will take a 48 months loan. Again, after this over, again you will take another loan. Again another 48 months. Like that, you will circle 4 to 5 times during your career in your country. You will come back and you will have only FD or that type of investment. You will not be having time to invest in mutual funds. So don't go for this loan unless and until there is a huge pressure to clear off some loan. This is a mistake by most of the NRIs in the Middle East. They have so many other fancy names to this. This is an actual case received yesterday from my new client. Another one. I don't want to name the state. You would have already realized it. Pravasi dividend scheme. It is offered 10% by the government. That is why it has been projected. Government is projecting. Lot of institutions are coming to the Middle East countries and other countries are making the road shows and people are investing up to 50 lakhs thinking that they will get 10%. So what is the actual condition? That if you go to the fine print of the government gazette notification in English, you can see only 1% is guaranteed by the government in addition to the interest paid by the nodal agency. The scheme is like this. Let us say you pay 10 lakhs to the particular Kerala. Sorry, I already told the name. Anyway, there's nothing secret. It is announced by Kerala government. Okay, there is a nodal agency. Okay, that nodal agency is doing a lot of construction work. And government want money for the nodal agency. So it's an easy way for government to raise the money. They are telling the nodal agency will handle this money and they will generate return and they will give you return and we will give 1% extra guaranteed. So what is guaranteed? Guarantee by government is only 1%. And below that, if you go through the fine print, you can see the nodal agency is offering 9% for the first 3 years. So it is projected as 9 plus 1, 10%, and it is guaranteed for life. Now, what is the catch in this? This 10% is guaranteed only for 3 years, and during this 3 years, they don't pay interest. It is added to the interest. That's also fine. But the product is a closed-ended product. If you invest 10 lakhs now, you cannot withdraw this money during your lifetime, not even your wife's lifetime. So till the time you are alive, you will get the interest payable by the nodal agency plus 1%. After your life, your wife will continue to get the same thing. After you and your wife, the money will go to your child. That is the scheme. It is sold by government. Be careful. Most of the governments are going to come with this product because most of the governments in India, they don't have enough money to pay salary unless they get money like this. Be very careful. It is hard-earned money. I am aware of 2-3 people who put even 50 lakhs in this case. NR deposit with the forward cover. In this contest, I will tell about the cheat schemes also. It is very common, but cheat schemes are very good. People who don't have any exposure in equity mutual fund or those who have need for short term. For example, if you want to create some money in the next 3 years, then you can join state government cheat scheme for 3 years. Nothing wrong in that. It's like your fixed deposit or something. But don't join the private scheme or a jewel scheme where you may lose your money. That is fine. But for the long time, keeping money in cheat and all, it's not a good idea. Another one, FCNR deposit with the forward cover. This is also sold aggressively to NRIs. What they are telling, they will again confuse you. Your relationship manager will come and make all the sales banda. He will tell you, sir, now Indian rupee is depreciating. Okay, there is no guarantee that you will make the money in the long time. So what they should do, we will give you a product which is linked to Japanese yen. Some people, we don't know what is the currency of the currency. They will come and teach you. We will give you a policy investment which is linked to the Japanese yen or Australian dollar. Okay, like that. And what they do, this is nothing, the forward cover. So they will take some money to ensure that they buy the forward cover. Which, see, I'll tell you, in finance, there are certain words which you have to be very careful. One is futures and options. If anybody is using this word, please run away. Another one is this forward cover. These things are applicable for the fund manager to take some calculator risk, but it's not possible for a common man like you and me to get into such things and make money. This is only to confuse you and do that. See, in this scheme, if you are having say 3-4 crores of money in FD, then you can think about say putting 5 or 10 lakhs there, because it gives a fixed maturity amount, higher interest rate, no currency fluctuation, and tax free. What is the disadvantage? You cannot redeem it before maturity. I personally believe you should not get into any investments which is not having liquidity. You should be in a position to redeem whenever you want. Except in the case of an FD, we are putting an NRI FD, it is locked for 1 year. That is fine. But other than that, you should not get into any complicated products where you get this type of things. I'm sure now you are all confused. Correct. Don't think that you are confused, because this is only because people are not taking interest in this. If you take some interest in learning things, you will always understand it better, because you people are come from highly educational background. You are doing your job in a much better way. And finance is not at all a complicated topic. It is a very simple topic. See, this is what is happening now. Somebody is telling that he was talking to the insurance agent about the retirement planning. At the end of the discussion, he came to know that it was his retirement planning. Whose retirement planning? The agent's retirement planning. This is what is happening almost 100% now. When an agent is selling a fixed amount of policies every month for 10 years, his retirement is made. I was telling this 20 years back as a branch manager of LIs. I used to tell all my agents, sell 5 policies every month for 10 years, your retirement is made. So that agent is still making money. But now, situation has changed. This policy has become so bad, a lot of new products have come. New products are equally bad. Luckily, a lot of other products are available out of insurance. So think about such products only. This is what you should do actually. You should not listen to an agent or a bank and listen. You should take stock of your situation, whether you are in India or abroad. What is there? You should analyze what is there in your kitty, what type of insurance policy you have, what is the life insurance you have, what type of health insurance you have, is it worth or not? This is what I do when I get a client. Second thing, analysis of mutual fund and other investment. Whether the bank has given me some products, is it good for me or good for the bank, good for the agent? Is it good for me or my children? Second thing, what I do is I'll help you identify your financial goals. This is a financial planning flow. Some people don't know what is a financial goal. Retirement planning is a compulsory goal which everybody should know. You have a child, the child's higher education is another goal. Buying a house is another goal. So many goals are there, but some people say that I don't know what is my goal. Then what will happen? They will think about the goal only when the goal is coming. So for example, if my daughter is coming with an admission in a good school, good college, and if I don't have the money, who is at fault? I should have planned it 10 years in advance. So that is not telling you. Help identify your goals in advance, plan. So that you do not wait for the agent to come and sell you wrong products. You know what is to be done. Matching the current investment with the goal. Whatever you are already having, you find out whether this investment will take care of this goal. And the proper asset allocation. I told you earlier how proper equity allocation, debt allocation, all those assets. Not put everything in the single asset and take the risk. Various investment within each customer. Again, the products are so complicated. Even a person with experience or person with the industry will find it very difficult to find out what is what. That is the way the cunning products are coming day by day. The same products which is certified by the regulator has been withdrawn after 3 years. You would have seen yesterday there's an article in Money Control. My name has been quoted. The highest NAV guarantee product. This is the product which I was fighting when I was in my earlier job. The product has been approved by IRDA. 3 years down the line, the same IRDA withdraw the product. And yesterday one article has come in Money Control on this. So you have to be very careful when you are investing in a particular product, because cunning product, 90% of the products in the market are not good for you. Only 10% are good for you. And nobody will push the good products. Only the bad products will be pushed. That is where we make mistake. Find out which is the best life insurance and insurance. Optimal way of tax reduction. How to reduce tax within the permissible law. Proper retirement planning. Believe me, this is going to be the biggest issue for everybody, not only for NRIs. Once you come back from your country to India, maybe at the age of 55, the India what you are going to see and the expense pattern is going to be like almost any other developed country. Don't think that the old village system of Kirana store, all those things are here now. No, we are all changed. We all shop Amazon, Flipkart. We don't go out, spend a lot. Weekly outing, all those things are very common nowadays. So don't think that you'll be able to reduce your expenses after retirement. You will be able to maintain the same standard of living even after retirement. So unless you plan seriously, we'll be having problem. And one thing, once you have all those things in place, the right instrument and the simple products, the only thing required is periodical review, as I told in the beginning, yearly once review and rebalance. What is rebalancing? Reducing the equity and increasing the debt as and when you are nearing the goal. So you should not wait for the last day of the goal to withdraw the money. So if you are needing the money, say 2025, by this time, you should be slowly moving to the debt. 3 years before the goal, the money should be almost 100% in debt. So that if there's a market crash also, you should not lose anything. That is how the financial life journey has to be planned. This is a journey which has to be planned very carefully. Think about what you are doing, working in another country, you are working for your family or working for others' family. I mean, the bank employees or for the insurance agents or the mutual fund agents. Don't spend time on unwanted things. Please spend some time on these things. Otherwise, it will be very late for you to recover. And by the time it will become too late, then you have to regret it. Slide about me only. I don't sell any financial products. Okay. I'm a fee only certified financial planner. That means I don't get any commission. I charge a fee and I register with the city as an investment advisor. So I feel happy to see your money growing. So don't think that it's a slide promoting myself. Offering unbiased advice at affordable prices. I told you in the beginning, there is an organization called Fee Only India. Okay, and the website is feeonlyindia.com. We are around 20 to 25 financial planners across India. We are not getting more people because people are not keen in this line because they want commission. So here there is no commission because we are getting only the fee. You can contact any of those people if you really need any help in managing your finance, and those people will protect your interest. There will not be any special interest in such cases. So that's it regarding the presentation. Now we'll get into question answers. So all of you are in mute form. You can raise your hand. Ajay will unmute you, and then you can ask your questions. Ajay.
Yeah, sir, I'm unmuting.
Okay.
You can ask your question. Anil?
He is not there.
Hello.
Yes, Balamurugan.
Thank you so much for the session, sir. It's a really useful one. Sir, I have one doubt about the PPF account. I have opened the PPF account before I come to Europe. So, okay. I mean, before my NRI status got changed. So now I'm continuing that PPF account. Is it mandatory to transfer the funds from my NRI account to the PPF account, or I still hold some of my savings account as it is without closing?
See, I told you technically, if you become NRI, then you are not supposed to keep the resident account, but most of the people keep it. So it is right or not, that's a different question. So once you become resident, non-resident, you have to convert that resident account to NRO account, and you are supposed to pay PPF from the NRO account. But I know many people are paying from the resident account also. It's up to you to change it into NRO and pay from NRO account. That will be easy, technically correct.
Okay, sir. Thank you. Yeah.
Welcome.
And sir, one more doubt. Also, I have a EPF account when I was working in India, and I have some funds over there. Should I still keep it as it is, and or should I close it? What should be the way to go forward?
How old are you now?
35.
Okay, don't worry. You will get the interest till the time you become 58. But the problem is every year you have to check whether the interest is getting credited or not. In case they stop paying the interest, then it's better to withdraw. Technically, you will get the interest till the age of 58. But the interest will be taxable. You got it?
Sorry, sir. There was some network hiccup. I couldn't hear properly.
Leaving the job, they will get interest, but the interest will be taxable in India.
Okay. So is it different for EPF and EPF then?
Hello?
Sir, my question is for PPF, it is not the, I mean, the interest is tax free. But
now
for
we are talking about the employee student. Mr. Ravi, can you hold for a minute? Let me answer Balamurugan, then I'll come to you. Yes, Balamurugan.
Yes. So my question is basically, whereas public provident fund interest is not taxable, whereas the employee provident fund is
Exactly.
taxable.
Exactly. Employees provident fund after leaving the job will be taxable even for a resident Indian. So if I'm 35 and if I'm sitting at home without doing, if I have 10 lakhs in my PF employees provident fund account, even but I will get interest up to age of 58, but the interest will become taxable. So unless I am continuously employed and the PF recovery is happening, the PF will become interest will become taxable after leaving the job. But I will get interest up to 58. So you have to get the account statement every year, check online, see whether your interest is credited, then be happy, don't withdraw.
Thank you so much, sir.
Yes, Ravi.
Hi, I have two questions. Question number one, I keep hearing a lot of buzz about bonds nowadays. The government issues bonds with some fixed, some attractive schemes. I would be really, I would really appreciate if you can put some more light on the bonds. Those are whether those are recommended for the personal finance portfolio.
See, when you are talking about the long-term government bonds, I don't recommend that because when you invest in a long-term bond, prone to interest rate risk. Except Ravi can address it. Are you listening?
Yes, I'm listening.
So what I'm doing. If you can tell me a specific one, I can answer generally.
Okay. Maybe I can contact you separately then. I have one more question. There is something called PIS and non-PIS things in the NRI accounts to invest. What exactly is it? I tried.
PIS stands for portfolio investment. That means if you once you become an NRI and you want to invest in stocks, direct stocks, you need a PIS account. That means you have to sell your stocks to a normal demat account if you are having a restricted status, and then transfer that into the demat account which is opened under the PIS scheme.
Melvin sir, can you just check if your two windows are open?
Voice is breaking. What is the problem? Ajay, I think there's a problem. Echo.
Yes, sir. There is echo. Maybe as soon as
others mute. Just a minute. Yeah.
So the question actually what I want to ask is, how does it affect the taxation on this PIS and non-PIS? Actually,
no, it has nothing to do with the tax. It has nothing to do with the tax because taxation is the same whether you are in India or NRI. The taxation is the same as far as stock is concerned. Only thing, technically, once you become an NRI, you are allowed to invest in a demat account.
Okay. That's all from my side.
Okay. Yeah. Ajay, next question.
Yes, sir. Arun, you can ask your question.
Hello. Yeah, I want to ask one question, basically.
Yes,
thank you so much. Thank you, Melvin, for this wonderful content.
Thank you.
Basically, I have two questions. One is related to this compounding effect. So when we talk about SIP, it potentially gives us the compounding, right? So that's why when we invest some 10,000 for 15 years or 20 years down the line, we'll get like 2 crore or 3 crore. So basically, this compound will get in the recurring deposit or in the fixed deposit. It will give us the standard interest over the interest. But when I put some amount, when I do the SIP in the growth direct plan, so it is also like a stock I'm buying for 10 rupees or 100 rupees. Over the time, it grows like 200 rupees, 1,000 rupees and all. So basically, it is doubles, triples like that, but I don't see any compounding over there. So why people say investing in mutual funds or direct mutual funds in a SIP will give us some compounded return? I don't understand this concept.
No.
So
If you don't withdraw anything in between by way of dividend, the growth will be visible in the case of net asset value of that investment. Correct.
correct.
Let us take now. I'll make it very simple to make you understand. Forget for a minute. It is not a mutual fund. You are putting in a shares. Let us take a Reliance RIL share. Okay.
Okay.
So you are investing. You are investing 2,000 rupees in an RIL share, Reliance Industry share. So
Okay.
this will keep growing. So how it will come? Let us say you will be getting some dividend in between. Okay, that is one way of getting return. And this 2,000 will keep growing and coming down depending on the market. It will keep coming and going. If you look at the next
Yes.
10-15 years and look back, your investment of 2,000 would have been much higher. That is where the money goes. So the
Correct.
performance of the company, Reliance in this particular example, that will reflect in the increase in value of the share of Reliance, which will given to you. So like that, when you are investing 1 lakh in a mutual fund, the growth option, the fund manager is doing the same thing. So instead of only one Reliance share, he is investing in various company shares in different proportion as per his reading of the market. And then based on that, those company shares will give the return. And that will reflect in the NAV of the particular fund. And that is the way it is. So whether it is FD interest and NAV increase there, compounding by way of interest on interest or mutual fund NAV, it will be getting the compounding impact.
Okay.
If you have,
Somehow it clears.
if you want to know more, I suggest you send a mail to me. In the email address given in that slide, I will answer you with an example also.
Definitely,
Okay.
definitely.
So one day you can call me also because it will take some time to explain.
Yes, understood. Yeah. Even I have been researching on the same topic, but I couldn't clear myself.
Don't too much research.
Yeah.
We can discuss and explain it in better way.
Yeah. But
And
anyways,
for
this helps
information of
me
everybody,
a lot.
if you have any queries, you can email me in this email address which is given, melvin@finmin.in. You'll be getting a thanks mail from another Gmail, but I will not be checking that Gmail regularly. So don't reply to that mail. That mail may go unnoticed. But send a mail to melvin@finmin.in. I will reply within 2-3 days.
Sure.
So that email address and my website address, phone number, everything is displayed in the slide.
Okay, understood. And other question, actually I joined at 9 o'clock, so I did not know whether you covered about this term insurance or not.
Yeah, that was the first slide. That was the first.
Okay, I think I missed it.
No problem.
Okay.
Which country you are?
I'm in Japan.
Okay, no problem. So there's a webinar which I conducted on life insurance. It is available in my YouTube, FinWin Financial Planner. That is a YouTube channel. There's a webinar on exclusively on life insurance, another one on health insurance. So that's a big topic that will be easy for you understand better if you attend that.
Okay, I'll check it out then. Okay.
Bye.
Thank you so much, Melvin.
When you can ask your question. Hello.
Yes,
Hello. Good evening, Mr. Melvin. Thank you for your session. A very useful session.
Thank you.
I have one question. Actually, my wife, she is in India since 8 months due to this COVID situation.
Okay.
She planning to open the PPF account, and he wants to start investment in the PPF. It is possible to do that one?
The thing is, you have to check whether she is having a resident status for this year. In that case, it is possible.
Okay. First, we have to check whether.
Yes. What happened now? The last budget, there is a change in the taxation rule, NRI status rule, depending on the number of days and all. You have to confirm whether she qualifies as a resident Indian in this year. In that case, she can open an account, then she can continue for 15 years without any problem.
Okay, thank you. Also, recently, 4 months before we actually my baby born, she is a girl baby. So we want to invest in Suganya Samriddhi.
So if she is in India and if she's a resident Indian, then you can purchase a Suganya now. But if you purchase a Suganya now and next year if she comes along with you, then become NRI, then you are not supposed to continue that Suganya. You have to close down technically. But some people are continuing it because unfortunately or fortunately, government is not having a mechanism to monitor this very closely. But if they found out at a later stage, you will not get interest.
Okay, Mr. Malin, thank you.
So I don't recommend, if idea is to come back to your place, I don't recommend Suganya for that.
Okay. This PPF account having any tax benefits for NRIs?
No, PPF is tax free for both for resident and the PPF. For NRIs. So when you are withdrawing, it will be totally tax free. Either you are NRI or resident India.
Okay, Mr. Narayan. Okay, thank you. Thank you.
Welcome. Welcome.
Hello,
Deepak?
hello, sir. Hello,
Yes,
sir.
yes.
This is Shiva. Sir, I have two questions.
Sure.
One is whether NRIs are allowed to invest in all the mutual funds. I heard from some agents that like we can't invest in.
Which country you are?
I am from Japan.
Okay.
I work in
So,
Japan.
Okay, I got your question. The restrictions are there only if you are based out of US or Canada. US
Okay.
or Canada investors cannot invest in all mutual funds, but now things are changing. Most of the funders are allowing, but other than that, all other countries there is no restriction, because if you are from US or Canada, then the mutual fund companies have to give some more disclosures to those governments. So some funders are taking the easy route of saying no to those countries. Japan, no issue. I hope a couple of clients in Japan, they are investing in all mutual funds in India also. Even now, I got a client from Japan today.
Okay, thanks, sir. And second question is, I have a term insurance of, for example, I have a term insurance of 5 crores. I have taken it when I am in India, when I was in India. So I just wanted to confirm, can I, it is not 10 times my annual salary. So is it okay to take in the same company, or should I diverse it to multiple companies? What is your
No,
advice?
it is always better to have life insurance only from one company with the prompt disclosure. So important thing, buying from different company will not reduce your risk or anything. You can buy from any company of your choice, because all companies are controlled by IRDA and equally safe. Only thing, disclose 100%. So in insurance, I always used to quote, honesty is the best policy. Even in life it is there, but in insurance is all the more important. So disclosed everything while purchasing that 5 crore policy, nothing wrong. Taking another policy from the same company for any value which you are comfortable. And don't go to multiple company and make the process complex. In case of a claim, normally you have to run around many companies.
Sorry to ask another question. So, what is your thought on the sovereign gold bonds that are coming up from RBI?
Sovereign gold bond is a good option if a person to diversify into gold, because that gives a 2.5% interest annually, and after that maturity benefit is tax free. But I think NRIs are not allowed.
Sorry, I didn't get your last word.
As per my knowledge, NRIs are not allowed to invest in sovereign gold bond.
Okay, understood, sir.
You can
Thank
you
you so
can you
much.
can purchase it someone in the family in India, that may be possible. But slowly they are changing it also. They are making certain things available to NRIs also. Maybe in a couple of days or a couple of years time, things will become more streamlined. But don't go very aggressive in gold, because what was said and done, don't have more than 5 to 10% of the portfolio in gold, because internationally gold is not giving very good return. In India, it is giving good return mainly because in Indian rupee is depreciating. Unless rupee depreciate further, it will not be giving huge return. Especially after this pandemic, I think gold price may go down also. Now because of the pandemic, it is spiking. After that, it may go down a bit.
Sir, thank you so much.
Welcome.
Deepak, you can ask a question.
Hello, Melvin sir. Thank you very
Hey,
much. Sir.
Dr. Dibat, how are you?
Hi, I'm fine, sir. How about you, sir?
Fine.
Sir, I had this query. Sir, NRIs, when they relocate outside, they have multiple options to invest, like US market and all. Should we restrict investments in US market from Indian fund houses, or diversify and invest from other platforms like interactive brokers?
See,
in which, yes,
in your case, since I know you, I know your financial acumen, I will say it is a yes for you, but may not be yes for everyone, because what will happen, unless you understand where you invest and what additional benefit it brings, it is better to avoid that. But the person who is having a reasonably good portfolio and who understand what is what and who can diversify, who can take the risk, it is better to diversify across countries also, but not in a big way, because whatever said and done, India is a developing country and US is a developed country, correct?
Yes, sir.
So a country like India, which is developing, will give much better return compared to US, which is a matured market.
Yes.
So within that, you can take a decision, have a small portion in US also. Maybe through the fund, you can be able to invest outside without invest through Indian platform. You can do that.
Yes. Thank you, sir. Thank you.
Manohar, you can ask your question.
Yeah, sir. My question is, recently Axis and Max Life they approached me for smart investor plan. It's an insurance scheme, fixed return. So they are telling for 10 years, every year you pay 10 lakhs, and after completing 10 years, you will be getting for next 25 years, every year 10 lakh rupees.
Manohar, can you tell me the name of that plan?
Smart investor plan.
Pardon?
Smart investor.
Okay. So what you can do is, I given my email ID in that thing. You can send a mail to me with the exact name and the brochure or whatever communication received from them. I will go through that because nowadays insurance companies are coming out with such innovation daily. So without knowing the exact policy, I cannot comment on that. But believe me, don't mix insurance with any investments. It's a thing. Except some policy which is offering around 5.8%. Nowadays, some guaranteed plan has come. Other than that, nothing is attractive for a person from NRI person.
But sir, as a diversification, is it good?
No,
Because
you email me the details. Email me the details. Let me check and tell you.
Okay, sure. Thank you.
Okay. Because generally these things are not good for you. But before making the comment, let me see the policy.
Yeah. Okay.
Mohan, you can ask a question.
Hi, good evening, sir. So,
Thank you.
yes, it is a nice session.
Thank you.
And I was almost following a few things with the help of some advisors like you who are giving already. But my question is, I was not allowed to start an PPF account 2 years before because of NRI status.
Okay.
Is it so?
Yeah, you cannot open. If you are an NRI, from that day you cannot open a new PPF account unless you come back to India and become a resident status. That's why I told you. I think you missed that presentation. If you're already having a PPF which you started earlier before becoming NRI, you can continue. Otherwise, you cannot open a PPF now.
Okay, right. And regarding this financial planning flow, which you have mentioned, is there anything that you count like a portfolio should be like 40 lakhs, 50 lakhs, something like that, or you're giving advices on any amount?
You're asking about my service.
Your service.
No, I have clients having even just 30,000 or 40,000 rupees monthly salary in India to even people who are investing even 5 lakhs per month who are working abroad. So I don't limit my clients to any type of thing. I have clients from the age of 25 to even people at the age of 75. So I take all people as clients because at the end of the day, I feel everybody should get the financial planning support. That is why I keep my fee also same for everyone. So for a person who's having very low income, he may feel it is slightly higher, but for others, it is highly subsidized. So I charge NRIs, I charge a fee of 22,000 rupees plus GST in the first year and 8,000 plus GST only from second year, which will increase by 1,000 rupees once in 3 years. That is the flat fee I am charging. And that is the only income I am getting. And they are getting the same service and what they are getting as a resident clients. They can contact me whenever they have any queries, and I will ensure that they are not investing in any wrong products.
Yes, Mr. Melvin, because I was suggested by Mr. Sriram. So I was interested to take your plan, but I need to know whether
Boston
yeah, yes, I am one of
yes. I know he's doing a lot of other financial planning activities, even sitting in US, and he's really doing something very good for the people who are from Tamil Nadu.
Because of his advice only, I changed to term plan. I
really wish if every state have one person like that Boston Sriram in India, financial literacy would have improved because he's taking that much of pain. I know personally what he's doing. Lot of effort he's doing daily and is helping many people from Tamil Nadu.
Right, Melvin. And regarding this investment, will you suggest some funds for investing in mutual funds?
Yeah. You will get the name of the exact policy to purchase, from where to purchase. You will get the name of the exact mutual fund to invest, how much to invest. All those things will be there on the financial plan. You can see even a sample financial plan I displayed in my website also. Everything is transparent.
Okay, Melvin, what should I mention in the mail when I want to get the financial plan?
You just send a WhatsApp message to me tomorrow. Okay, that I am interested in taking the service. I will take it from there. Don't worry. Okay.
Okay, fine. Thank you, Melvin. It's nice speaking with you.
Thank you. Welcome.
Mohan, you can ask a question.
How many more people are there?
Meenakshi, you can ask a question.
Hi, Mr. Melvin. How are you? I am from Qatar. First time I'm listening your, I'm attending this conference first time through Boston Sriram only.
Okay,
So you
okay.
only given all the link to me.
Okay.
But thanks, very useful slides actually you are presenting. First I want to ask you, but I am age of 50 now. I am planning to invest around 50 lakhs rupees in the share market equity through PMS. Whether is it advisable or not at this age?
No,
First of
no, no,
all.
don't go to any PMS even if you have 10 crore.
Oh, okay. What is the then how to invest this one?
I'll tell you, when you have 50 lakhs, if you give to PMS, what is happening? They have a highly concentrated portfolio in the sense they don't invest in large number of shares. They will go for a very limited number of shares. Okay. So the 50 lakhs will be invested across maximum 10 or 15 company shares. That carries risk. Are you hearing?
Yeah, please continue, sir. Please continue.
Okay, so investing in a limited number of stocks is the way PMS manage. So it is not a transparent product. In that way, I don't recommend PMS. Even if you have huge money, it's always better to go to a normal mutual fund where they invest. If you have investing 5 to 6 mutual funds, you will get an exposure to around 200 to 250 companies shares. That is the best way to invest money through proper diversification. So I don't recommend PMS service. If you go to PMS now, I'm sure 3 years down the line, you will get out of PMS. You will not continue. I've seen most of the people who are going there and stuck there after 3 years, they are getting out and they invest in mutual funds. If you have huge money, so maybe 5-10 crore, then you can think of one PMS of 50 lakhs, provided you feel that greedy. And later, after 3 years, sure, you will also come back.
Yeah, then Melvin, suppose if I need your support by investing this 50 lakhs,
I'll be recommending only mutual funds as part of my financial planning service. Okay.
Yeah, if I contact you, then will you help me?
You can contact me through email or WhatsApp tomorrow. Then we can take it forward. Okay, so let us answer some queries now for the benefit of everybody.
Thank you.
Okay, welcome. Who is next, Ajay?
Pankaj, you can ask a question.
Hello, sir.
Good evening, Mr. Malul.
Yes.
Thanks for your session. I have one query.
Yeah.
I have some ELSS mutual funds that I had opted in before I moved to Europe here. Now I want to get out of that because I do not pay any tax in India.
Okay.
So can I convert those funds in some other funds, or I need to get it or need to withdraw it because it has lock-in period of 3 years?
You cannot take it before 3 years. So once you complete 3 years, then only you'll be able to take it. Otherwise, you cannot redeem it.
So I can convert it to some others, or first I need to.
No. You cannot touch it before 3 years. You cannot even make that regular plan to direct plan before 3 years. So ELSS is a product which cannot touch before 3 years. So it will continue like that only. So don't do anything. Keep it there. Get the account statement and keep it with you after 3 years to sell it and reinvest in the other normal open-ended products.
Okay. Yeah. Thank you, sir.
Welcome.
Yeah.
Deep, you can ask a question.
Hello.
Yeah.
Hi, good afternoon. Thanks for such an informative session. So in between the sessions, you mentioned that we can invest directly into the direct mutual fund, and there is some website I think you mentioned. So how they will keep our mutual fund in there? So they will create another Demat account, and it would be linked to NSDL, and under the SEBI guidance, they will keep this mutual fund.
Yeah. These platforms are just intermediary. They don't do anything. They just collect your money and invest in the mutual fund. So, for example, the platform what I recommended to my clients are MFU and Kuvera. So, I personally use Kuvera for the last 3 years, and I'm very happy with that. It's a new generation platform which is very user friendly. So, I am using it. So, I can go like an Amazon cart and do all the purchase or sale like that. So, whatever investment you are doing through any platform, within 2-3 days, you will get the account statement from the mutual fund company. That is the proof that your money is invested. So you have to ensure that you are getting the statement so that you are sure of your investment.
Okay. And sir, we have say I have already 50, 60 lakhs in mutual fund. So I can convert then all my mutual fund into direct plan from this website also?
No, yeah, you can do that, but converting mutual fund, you have to see the taxation impact also. Converting means you are selling that regular plan and buying the same fund under direct plan. So it have the same tax implication like selling. So you have to be careful about the tax implication, then only do that. Especially if it is within 1 year, don't sell because then there is a short-term capital gain tax. If it is more than 1 year in equity fund, it will be long-term capital gain tax. So you have to see the tax implication, then only sell that. So you consult your CA before selling it.
Right, sir. And sir, so the KYC and all that the website will do for on our behalf, or I have to go to each mutual fund website and do the KYC?
You are already investing in mutual funds, correct? Through the agent.
Right, yes.
So that means your KYC is already in force. Now you need not do any fresh KYC for investing in direct plan. You can do any mutual fund. You can invest in direct plan sitting in your country itself.
Right, sir.
Okay,
sir.
Okay.
Rajesh, you can ask a question.
Good evening, Mr. Melvin.
Hi.
Regard investing in my portfolio, we can consider for investing in real estate. We'll consider, even though we have own house.
No, I'm not clear on your question. You're asking real estate investment has to be
When compared to a mutual fund, investing in the real estate also is advisable, or
that depends on where you invest and the growth prospects. If you ask me 10 years back, it was nice, but now the golden days of real estate is already over. You look at the property and all for last 5 years, there is no much growth in most of the place. So unless you have a huge money to take care of all other goals, don't go for further investment in real estate. What will happen? If you have one house, it's a must for everyone. But then if you go for another house, your investment capacity for other goals is affected. So unless you have enough money to take care of your children education and your retirement, don't think about going for another property. That will impact your personal financial life.
okay. Thank you, Mr. Melvin.
Siva Prakash, you can ask a question.
Yeah, I already asked. I think like I will lower my hand.
Okay.
Tejas, you can ask a question.
Sir, I also asked my questions.
Also already asked, please lower the hand so that Ajay will be able to understand who is still having doubt. And any questions already cleared for someone else, if they are having same question, you can lower the hand also, please.
Venkatesh, you can ask a question.
Sure, thank you. Melvin ji, this is regarding debt fund investments for NRIs.
Okay.
So you said debt funds are not advisable for NRIs because of the tax inefficiency, because the NRI FDs are much more tax efficient.
Yeah.
But for those who want to invest in debt funds and not withdraw it till they come back to India after retirement and let it accumulate and withdraw only in parts, so that if I'm not wrong, debt funds are taxable only at withdrawal, right?
Yes,
only when you withdraw.
Right. That's right.
So what do you advise then for such cases?
What will happen if that particular fund is not performing after 3 years? That is the catch.
Okay, you're looking at the safety aspect more than the growth.
Because in mutual funds, any investment, you have to do the review and make changes. For example, if there's a Birla Sun Life dynamic bond fund, once upon a time was a star fund. Okay, now it is not performing. So what will happen if you have 10 lakhs in that and there will be a gain, but underperforming for many years? Then you have to carry on with that till the time you become resident. Otherwise, you have to pay the tax there at the time.
Yeah, I think you answered my point. Thank you very much. Thank you very much.
Anybody else? I've unmuted all. You can ask a question.
No, a lot of people are raising hands there.
Hello.
Yes.
Hi, Mr. Melinji. Yeah, good evening. Thank you for the talk. I just wanted to understand about real estate distribution and allocation. How much of our total asset, if at all one want to invest in real estate, maybe plots or maybe land percentage should be in the real estate?
See, I'm telling you, there is no hard and fast rule for this, because I know some people especially in South and all, who's living only on rental income. So if they get at the right place, the right location and all, they may win also, because if they are getting tenants and all those things regularly. But at the same time, I told you the example of a NRI person who was going back to Middle East again to work after the age of 55, after retirement. So these things are depending on the location. Real estate is a problem depending on the location, depending on the upcoming projects in that area and all, it will highly unpredictable. So if you feel equity is volatile, real estate is more volatile. That's the problem. We can't plan anything with that. That's the issue.
Yeah, I understood. Yeah,
Okay.
thank you very much. And I'm sure you don't recommend the cryptocurrencies, right?
No, not at all. Not at all. I don't
Okay.
recommend any product which I am not 100% sure about. Crypto is a subject which is still not known fully to everyone, including the government of India. So I don't recommend crypto at all.
Right, I know that. Yeah, thank you very much. Thank you.
Mr. Melvin, sir, can you hear me?
Sure.
Sir, regarding your section is good. Actually, I want to open a new PPF. So I have 25 lakhs, which is a good option to invest in India.
You're
So I'm in
asking
right now, sir, yes.
You're asking about PPF. You cannot invest PPF 25 lakhs.
No, actually, which is the best one I am asking, sir?
Asking the question, you have 25 lakhs and you want to invest in India, correct?
Yes, exactly.
See, I'm telling you, I can't give an answer to that without knowing your profile. If you ask that question 11 years back, when I was working in insurance company, by this time, you would have already become my policy holder. So don't ask this question to anyone, including me. Okay.
Okay.
So what you should do? You should do a proper analysis, like what are the financial goals coming up? Whether you need this money in the rest of 5 years, 10 years, 15 years, like that. Then based on that, you take a decision and then invest in equity and debt accordingly. Within that, go for only FD from NRI account.
NRI account. Okay, sir.
And whatever money you decided to invest in equity, don't invest in lump sum now because market is at all-time high. Lump sum investment in equity is not recommended. Go through systematic transfer plan. Put the money into a liquid fund and transfer in the next 15 to 20 months only.
Okay, sir. I will also contact with you in the email and mobile, sir.
Sure, please.
Okay.
Please.
Thank you, sir. Thank you for your section and very nice.
Welcome.
Girish, you can ask a question. Ananta, you can ask a question.
Yeah, thank you for that. Hi, Melvin. That was a great session we had. I have a basic question here, actually. So if we get your advice, actually, I'm new to this. Actually, I'm getting some information regarding the financial planning and all. So if we plan to invest in mutual funds and all, so on a yearly basis, so as per your advice, how you see how much percentage you would get as a returns on an yearly basis?
Yeah. Very good
approximately
question.
A kind of percentage.
Very good question. Let me tell you, not only me, no financial planner will guarantee any return. A financial planner will explain you what you should do, where you should invest, and tell you the likely indicator return which you will get. So he asked me the guarantee next year, even from equity, I cannot even guarantee 5%, but it can be even 50%. So equity is a product which will not give any guaranteed return any year. But I invest my money, a good portion in equity, because I know in the long term it will perform. So you should do that according to your goals, according to your risk profile. And everybody are not comfortable with equity because if there's a volatility, such people will get tension. Such people should not invest in equity. So you should do that proper risk analysis, and only after that you should invest in equity. Otherwise, don't invest. You may lose your money. Equity, the assumption what I'm taking for calculation is 10% from equity and 6% from debt. But even that is not guaranteed year after year. It may come in the long term. So you should understand where you are investing, then only invest. Otherwise, you will lose money.
Okay, got it. Thank you for it.
Anyone else want to ask questions?
Good evening, Melvin, sir.
Yeah.
Mr. Melvin.
Go ahead.
Please, Mohan.
Yeah, good evening, Melvin, sir.
Good evening.
Thanks for your session. Actually, I have a question regarding the insurance. The term insurance, actually, I've already taken before 1 year. But the thing is that I have taken endowment insurance plan before 8 years for the term of total 16 years. So my question is whether to continue the endowment plan or to withdraw.
So out of 16 years, 8 years are already paid, no?
Yeah, 8 years I have already paid.
Because now you have to pay only for another 8 years, correct?
Yes.
Okay, so if you're, how much is the annual premium?
Annual premium, it's 54,000.
Okay, so I think you can pay that because even if you surrender that policy, you don't have time in the next 8 years to recover the loss. That's the problem.
Okay. So I have to continue with the endowment.
In your case, since the policy is maturing in the next 8 years, it is better to continue that because you don't have time. But if it is a 30-year policy, I would ask you surrender now and the loss out, invest out.
Okay, sir. Thank you very much.
Okay, Balaji.
Mr. Melvin, this is Girish from Dubai, UAE.
Hi.
Hi, Mr. Melvin. How are
Please,
you?
please. Go ahead. Fine. I'm fine. Go ahead.
Okay, Mr. Melvin, I've got one question. See, my wife has been doing an SIP in Access Long Term, which is an ELSS.
Okay.
So that is a locking period for 3 years,
Yes.
isn't it?
Yes.
So and she's continuously doing she's continually doing the SIP and it's giving a good return.
Okay, it is not required because as long as you are NRI, you are not getting any tax benefit out of the DLSS. So ask her to stop the SIP right now and wait for 3 years from the date of last SIP to withdraw the money. Otherwise, she can segregate the units which are more than 3 years old that can be sold now. But stop the SIP immediately. So I don't recommend SIP in ELSS fund at all because of this issue.
Okay, sir. Okay, because she's doing ELS because she's getting some rental income from India. That is why.
She is a taxpayer in India, and if she's doing it for the Section 80C tax benefit, let her continue.
Thank you very much, sir. Thank you.
Hello.
Yeah.
Hello.
Hello. Who is this?
Yeah, this is Rajkumar from Qatar.
Yes, Rajkumar, tell me.
Actually, I have some doubts regarding this mutual funds. I have some mutual fund. It is a regular plan growth.
Okay.
Is it possible to change? Because a lot of time I called this bank. They told it is a good plan and no need to change. And like this regular plan growth, it is okay or need to change, sir?
No, I already explained. I think you have not heard that. A regular plan means there's an agent is involved. In your case, bank is the agent, correct? So you are losing around 1% of your money every year to the bank or the agent as the commission.
Yes.
Then next year again you are losing on the same amount. Even if you are not investing, you are losing again. So there is no meaning in investing in regular plan through bank or agent. You can convert that into a direct plan and you can continue to invest in direct plan in the same fund if they are good, otherwise in better funds. So that will be the better option for you in the long time. Otherwise you will be losing money just because keeping in the regular plan.
Okay, sir. Thank you, sir. Thank you.
Hello.
Yeah.
Hello.
Hello. I'm hearing.
Yeah, Melvin, that was a nice session. This is Satya here.
Thank you.
Actually, I just want to ask a question. Like you spoke about emergency funds.
Yeah.
Emergency funds for us to keep in the bank, the bank in the country which we are in. Is it good or to keep as FCNR and so that it can be repatriable at any time?
You can have any option provided it can be redeemable in 1 day notice or 2 day notice maximum. Some amount should be in savings bank, of course. Let us say I'm going to the hospital with my wife. I don't have time to go to mutual fund office already online. I want a ATM card to swipe and get the money. So I want some money in savings bank, correct?
Yeah, right.
So money should be in your country of your residence in the savings bank of the bank, number one. Number two, some amount can be in FD to get some interest because you are not going to use the entire emergency fund now.
No. My question was not FD. Maybe I was not clear. I was thinking about FCNR accounts. It is an FD or it's a savings bank, like in Indian bank.
FCNR deposit is mainly meant for deposit only.
Deposit only. Yeah.
It's a deposit of 1 year and above only.
Yeah, because you spoke about 1 year of expense to be kept in the country.
But I'm telling in the case of NRIs, if you break the FD before 1 year, you will not get any interest.
Correct. Understood.
So in effect, you will be keeping maximum money in savings bank only for the emergency fund.
Yeah.
So you can think about whether it has to be in the Indian bank or the local bank, depending on the interest, because you may not get any interest at all in some cases. But that is one thing which NRIs has to keep. So what you can do is 50% of the emergency fund, you can keep it in FD, thinking that you will not be using it. Balance 50%, keep it in savings. In case of emergency, you withdraw that FD, you lose the interest.
It is always better to keep some amount, some feasible amount in the country of residence, right? So then.
Yes.
Yeah. Okay. Thank you, Melvin. Right. Thanks. Bye.
I think we can finish this. Yeah.
I think everybody has been answer.
Hello, Mr. Melvin. This is Ashwin. I got one more question. Sorry for that.
Sure, sure.
This, regarding mutual fund, is Motilal Oswal now they have one fund for a US large cap fund. Is it preferable to take that US market large cap fund, or what is your suggestion?
You're talking about the Motilal Oswal Standard and S&P 500
index, yes.
That is a good fund. Even though it has started in India last year, it is investing in S&P 500 index, which is a very old index. So we can do that, no issue. But only thing, that fund taxation treatment will be like debt funds in India. All international funds will be treated as a debt funds in India for taxation.
So it will be more taxable, or what is
No, I'm telling you, even in the case of an NRI investor, that will be the taxation will be there at the time of selling. That you can't avoid it. But to get an exposure in US market, that's a good option. So you cannot have everything. You can have an exposure and you cannot avoid the tax also. So you should be prepared for that.
Okay. For other funds, for NRI, that it will be tax free.
No. All mutual funds are taxable. Same tax applicable for residents and Indians. Sorry, NRIs. You cannot avoid tax.
Okay.
So after 1 year in the equity, 10% gain, 10% tax if the gain is above 1 lakh. That is mandatory. You can read the article in my website about taxation and everything has been explained there.
Okay. Thank you, Mr. Melvin. Thank you.
Welcome.
Hi, Melvin. This is Abhiram here. Just one more question. Thanks a lot for the session.
Let it be the last, Abhiram. Okay. Thank you.
Yes, sure. Yeah, definitely. I mean, this is just a general question regarding the NRI status. So let's say if someone decides to become the citizen of the country that they're living in currently. So if the status changes from NRI to OCI, what happens to all the investments that we have made back home, be it mutual funds, real estate, or anything? Will there be an impact?
No. Now most of the fund houses are allowing investment of even OCI. Even there are people, even foreign citizens continue to invest. So you have to see the taxation impact at that time. It may keep changing also. So in budget after budget, India government is making things liberal even for the other citizen to invest in India. I have clients who become OCI of Australia and then going to become citizens of Australia. So they continue to invest in India as long as this is going to be banned. So as of now, there is no issue. People are continuing. But there are certain restrictions of such people. So, for example, some fund house don't allow investing even from OCI because the fund house has to disclose details to the respective government. So some fund houses who are not interested in such things, they avoid taking investment from such clients. So you have to see which country you are, which country residence you are going to take, and which citizenship you are going to take, whether Indian mutual fund allow investing, that country investors like that. And based on that, you have to do that. Strict regulations are more mainly for US and Canada. Other countries are slightly better. But it is not a static, it keeps changing every year. So you have to consult a proper chartered accountant before taking decision of selling or buying or anything like that.
Okay, thanks, Melvin.
So let us wind up here, and thank you for all. Till even now, almost 50% of people are still remaining. So all the people who are already having any queries in mind still are unable to clear the doubts can send a mail to me at melvin@finvin.in. Don't use my Gmail, I may not check that. Melvin@finvin.in is the best way to reach out to me, or you can WhatsApp me. I've given my number there. And thank you for the patient listening. It has gone to more than 2.5 hours now. I know some of them are having very odd time. So let me thank you here, and good night for the people on this side of the world, and good morning for the people from the US and Canada. Thank you.
Melvin, can I ask one question?
Thank you, Melvin ji.
Thank you.
Melvin, thank you very much.
Somebody asked a question.
Mr. Melvin Manohar again here.
Please. This is going to be the real last.
Sir, very simple question. Mutual fund, when you are selling after 1 year, you pay tax long-term 10%, correct?
10% tax if the gain is above 1 lakh.
Above 1 lakh, yeah. So can it be get in the tax returns? Can I get the money back in tax returns if I file?
Yeah, you have to file the tax return, and then only you'll be getting the refund. So in case NRI, they will deduct the tax because the government want to ensure that you are paying the tax. So they will be deducting the tax, and you have to file the return, and at that time you'll be able to get the refund of that gain.
I see. Okay.
If you are eligible within that 1 lakh, anything above 1 lakh, you will not be eligible, like in the case of maintenance.
Okay. Thank you.
Okay then. Good night. Thank you.